Hi friends, now we are going to discuss one circular on liquidated damages or any amount collected for breach or non-performance of contract. So up to August 2022, until the time this circular has been provided, we were interpreting that any amount that is collected for breach of a contract so will be called as consideration for tolerating an act, and that will be chargeable to GST. So that was the clarity, or that was the interpretation which many people were following. Finally, this big circular has been provided in the year 2022 August, and this has completely modified the interpretation what people were having until that point of time. So first, we need to understand, so what is this liquidated damages is all about. First, a person enters into contract with another person, and whenever there is a non-performance of the contract or breach of contract, so as per contract one performance is required. So upon non-performance of contract or breach of contract, so some amount will be collected or will be given by one person to the other person, so in order to compensate the loss or the injury or the damage caused to that person. So this is what is called as liquidated damages, and it is clearly given in Contract Act, and section 73 of Contract Act 1972 says that when a contract has been broken, the party which suffers such breach is entitled to receive from the other party compensation for any loss or damage caused to him by such breach. And another general meaning of liquidated damages is like it's a cash compensation agreed to be signed or written contract for breach of contract payable to the aggrieved party. So it's a cash compensation payable to the aggrieved party. Now, so this is the meaning of liquidated damages. So whether this compensation, whatever is being collected, will be treated as consideration first of all. So, and will it become supply? So that's our next issue of discussion. So the first issue is what is the meaning of liquidated damages that we understood. So liquidated damages means what as per contract act, as per general meaning. The next aspect is it consideration? Generally, liquidated damages is consideration or not depends upon whether that money collected is merely to compensate the loss. Merely to compensate the loss, and it is not an independent activity. Okay, it's not an independent activity, because it's like, suppose I am tolerating your act, this is your act which I am tolerating, for which you have to pay this much charges, like that if it is given, then only it will be consideration. Suppose if it is a mere compensation for loss or breach or injury, that is not treated as consideration. That's what they are telling in the circular. So how that money should be? So the person who enters into contract should specify, say, you are not going to pay this on time. So if you delay this, I'm going to collect some late fees from you, like that. Or suppose if you are taking a loan from me and I'm going to accept if you pre-close, so that should be there. Upon receipt of that money, the person should have accepted that. So then only it will be called as tolerating an act or consideration for tolerating an act. So because mere receipt of compensation will not restitute that person anything. So then it is just to compensate his loss or just to compensate his injury, then it will never be called as consideration. So how the money received should be? The money received should be for a object. What is that object? That is, I am receiving some money because I am only telling you that if you do this much charges you need to pay, so that I will regularize it. So in the general commercial terms, it should be specified. So that's what, like pre-closure charges or like some charges for cancellation. So these kind of charges, whatever is collected, that will only be treated as consideration. As such, not all liquidated damages will be treated as consideration. So that is only provided in the circular mainly. Okay, then so liquidated damages, whether it will be treated as consideration or not, depends. Mere compensation to compensate the loss or damage or injury, not treated as consideration. Okay, otherwise, so specifically expressly provided in the contract, then it will be treated as consideration. Okay, now the next aspect that we need to see is, will it become supply? Yes, if there is a consideration and for which the activity is what? So there is no activity, is just the consideration. They are mentioning in the contract that if you are doing this, like if you are making payment late, it's okay if you pay the late charges, like that. So then what is its taxability? How we need to understand? Is it supply? Yes, it is supply, but we should not treat it as again an independent supply. So this will be treated as an ancillary supply to the principal supply. So now they are bringing the concept of composite supply here. What they are telling is that any consideration that is liquidated damages treated as consideration will be as per the contract. So now there will be one principal supply. If the principal supply is taxable, then this charges collected on account of breach is also taxable. For example, you take railway tickets. In case of railway tickets, so usually sleeper class and second class sitting, etc., those tickets will be not taxable, exempted. Reason being, in case of railways, only AC will be taxable, and that too first class will be taxable, AC or non-AC. AC, all classes will be taxable. So for that cancellation, if there is any cancellation charges collected, so then it would be chargeable to GST. Whereas for normal second class sleeper tickets, if there is cancellation, and for that if cancellation charges are collected, those cancellation charges are not taxable, because it depends upon the principal supply. So previously we were interpreting it as standalone supply, but they are telling no, don't see it as a standalone supply, see it as an ancillary supply which is part of a principal supply. So that is only being provided in the circular, the next aspect. Okay, then now therefore what is that we need to understand? The conclusion from this discussion is that first we need to see any amount received or liquidated damages received on account of breach of contract or non-performance of the contract. That is divided into two. The first thing, it is mere compensation. It is mere compensation in order to compensate the loss incurred by a person. It is mere compensation in order to compensate the person who incurred the loss or damage or injury. Then not treated as consideration, and therefore it is not taxable. Suppose if it is specified in the contract that upon this happens, you need to pay these charges, like that clearly it is specified in the contract, then we need to see again whether those charges are like penalizing a person or those charges are collected in order to discourage such act or situation. So that's the second, that is specified in the contract. Even if it is specified in the contract, why are they collecting it? So they are collecting it so that this kind of situation should not repeat. So then it will not be treated as consideration. For example, check dishonor charges. This check dishonor charges, if you see, check dishonor charges are mainly to discourage a person from doing it. Even though there is a contract, all those things are there, but that will not regularize the transaction. That will not regularize the transaction. So they are telling in order to discourage a person from doing that, they are collecting. So therefore it will not be treated as consideration and not taxable. Suppose if it is other cases, what are other cases other than this? Not to discourage a person, it's okay to regularize the transaction. You pay it and still you will be able to get that services. So then it will be treated as consideration, and its taxability depends upon principal supply. Okay, so this is the summary chart what you need to keep in your mind. Continuation to this circular, they have given different situations, different scenarios. So whatever we have seen so far is given in the circular. Apart from that, few examples are also given. In that, one by one, we are trying to understand. The first scenario that have been mentioned is about compensation for cancellation of coal blocks. So in the year 2015, so this coal block scam has happened. Like many coal blocks were allocated by the government to various parties, and Supreme Court gave an order that all these allocations are irregular, so are not proper, just like the 2G scam kind of. So this coal block allocation scam has happened. So therefore Supreme Court said that no, whatever blocks that are allocated needs to be taken back by the government, and if government wants to pay the compensation, they can pay the compensation to those parties. So that's how they have made the law. So now, in that case, that is, it's a Supreme Court order. Because of the Supreme Court order, what has happened to those people to whom the coal blocks were allocated, they have returned that rights to the government, for which government has given some compensation. Is this compensation treated as consideration? No, because nowhere it is mentioned in the contract or agreement that the person to whom coal block is allocated, upon cancellation of allocation by the Supreme Court or any other case, they have to return it, and for which government will give this much of compensation, is nowhere mentioned. Moreover, it is not like an option for them there. They have to mandatorily adhere to the Supreme Court law. So this is mere compensation to compensate the loss or injury or damage to that person. So therefore, this will not be treated as consideration, and consequently it will not be taxable. The next situation is about dishonor charges, check dishonor charges, or check dishonor fine, or check dishonor penalty, anyway we can call it as. So this check dishonor charges, what about its taxability? Even though it is mentioned clearly between the account holder and the bank that, so whenever you dishonor the check, you have to pay these charges, but these check dishonor charges will not regularize the transaction, and this is to discourage a person. This is like a penalizing a person or discourage a person from doing that in future. Again, this will not be treated as consideration, and it will not be taxable. The third scenario is about traffic fines. When the traffic fines are being collected from the people who violate the traffic laws, now it may be specified in the contract, that is, there is no contract as such. So this is like, again, so for what purpose they are collecting? So in order to discourage a person. So here there is no loss, compensation, all these things. So here it is mainly to penalize a person or to discourage a person from doing it. It's not like, if you pay the fine, you can cross the traffic signal. If you are paying the fine, no need to wear the helmet. If you are paying money, you can drive the car rashly and kill a person. So nowhere it is mentioned like that. So how can you say that this money paid, the transaction gets regularized? No, this is just to discourage a person from doing it. So then it will not be treated as consideration, and consequently it will not be taxable. Then the fourth scenario is about an employee not serving the notice period and leaving the employment. Then in that case, what will happen? So again, so this money, whatever is collected, will it regularize the transaction to the employer? No. So why they are levying some charges? Usually notice pay will be withheld. So that will not be given, or any benefits like leave travel concession benefits or paid leaves, etc. will not be released to that person. So the amount will be forfeited. So why this forfeiture will be happening? So this will be because, to discourage the other employees who are in the organization from not doing this kind of activity. So this will not regularize. So it's not like, I can pay the money so that I can leave anytime, not like that. So due to that reason, again, this will also not be treated as consideration, and consequently, it will not be taxable. Okay. And then next one, the fifth scenario that is provided is compensation for not collecting the toll charges. That is, generally, a person who constructs the road is required to get some toll charges. That is, whenever he makes an investment, so he need to recover that investment by way of toll charges. For recovering that investment by way of toll charges, what he will do, so on the vehicles which are plying, he will be recovering. Now what has happened, they did not collect toll charges for a particular period. So for that period, so what has happened, as they could not collect the toll charges because of some contingency in that road, etc., government order something. So now government has given that money to the person, that is that builder. So now will it be treated, this is like a compensation for not collecting the toll charges, will it be treated as consideration? Yes, because it is to regularize the transactions. So this is not merely to compensate the loss, it is to regularize the transaction. It is as good as consideration received from another person. So that will be treated as consideration and it will be taxable. So it is not like an ancillary activity. This is like money received as good as from another person. That's how it should be treated. Then the next scenario is about late payment, surcharge or fees. So this late payment charges, surcharges or fees, whatever it is, it's like treated as ancillary supply and depends upon the principal supply. These are treated as consideration because it will arise out of the contract and clearly it will be mentioned that if you do this, I will be collecting some amount. So this is not to discourage a person because the people will understand that in the normal course, for example, electricity bill, if you pay late, this much charges you need to pay, like that. So in the normal course, they will be knowing that. So usually some people will do these activities. So therefore, in commercial terms, they will be specifying it in the contract. For that, if any amount collected, that is consideration. And again, its taxability depends upon principal supply. The previous example what I gave you, electricity. Electricity, first of all, will be exempted. So for that, if they collect any charges, even that is also exempted, like that. Okay. Then, so therefore, whenever the principal supply is taxable, the ancillary supply in the nature of money collected for non-performance or breach, etc., that will also be taxable. Then the next situation is related to cancellation charges. Cancellation charges which are collected by the railways, if you take. So again, so already we discussed that example. If this principal supply, that is normal, if the normal thing, that is if the reservation class, so in that first class ticket or any AC ticket, if that is cancelled, so that cancellation charges is also taxable. Suppose if this is a normal sleeper ticket, for that cancellation charges will be exempted, but yes, that will be treated as consideration. Then next thing is about amount forfeited in case of non-refundable ticket. For example, it so happens that you book a air ticket and you did not travel, and cancellation also is not possible. Now that money forfeited, they did not provide you the supply, but actually here what has happened is that, so you booked the ticket, so they could not provide that seat to any other person. So therefore, even though these charges which are collected, but these charges will be taxable. Why? Because, so if they have provided the service to any other person, so they would have paid GST. Na? So in that logic, so whatever money that is collected, so retained, forfeited, so will be coming under taxability. It will be chargeable to GST. Then the last situation is about forfeiture of advances. Usually when you see a property, you will pay some advance to that property. And now you are not buying that property. So because of that, they will forfeit the advance. Now, in the case when they forfeit the advance, so now will it be treated as consideration? No. So because it is as good as, so compensation received for any loss or injury or damage, because there is no supply that is involved in that case. They are not selling the immovable property and all. So therefore, that forfeiture of earnest money for breach of an agreement, so will be coming under mere flow of money, first case. So to compensate the loss or damage or injury, that will not be treated as consideration. Now we are moving on to the next segment, that is registration. There are no amendments in composition scheme segment. So now we are moving on to registration. In this registration chapter, so there is one automatic revocation of suspension that has been provided. What is this automatic revocation of suspension? First, usually there are some cases where department can initiate cancellation of registration. When department initiates cancellation of registration, what is the first step? The first step is that they will be giving a show cause notice for cancellation. And after giving the show cause notice for cancellation, maybe any reason for on account of non-filing of returns or any reason, but here what we are trying to understand is on account of non-filing of returns. And what happens? First, there will be suspension initiated. So the second step is initiation of suspension. Now, till the time they do the cancellation proceeding. So in the cancellation, what will happen? Cancellation proceeding, outcome of the cancellation proceeding is what? Either they may give a cancellation order or they may drop the show cause notice, correct? Either they may give cancellation order or they may drop the show cause notice. That is the cancellation proceeding. So from the time when there is suspension till the cancellation proceeding, there is a time period. In the time period, if you file the returns, so you have got the notice because of not filing the returns. So because of that only the initiated cancellation. Now during the period of suspension, if you file the returns, then there will be automatic revocation of suspension. So that point has been specified. The next amendment in registration chapter is related to situations that leads to cancellation of registration. Already there were some 5 situations where proper officer suo motu can initiate cancellation of registration. What were those 5 situations? Number 1, if registration has been obtained by fraud. Number 2, you have got the registration voluntarily but not commenced business within 6 months. Or number 3, contravention of provisions of the act or rules. And next 2 more is related to non-filing of returns. You are under composition scheme and you did not file 3 consecutive returns, and you are under normal scheme and you have not filed 6 consecutive returns. That's how it was. Now these last 2 points were omitted. So these 2 points were omitted. In that place, they have brought in a new point. What is that? It says you are under composition scheme. You are required to file an annual return. What is the time limit by which annual return needs to be filed? By 30th April of the succeeding financial year. So within 3 months after the due date, if you are not filing the annual return, then they can initiate cancellation of registration. So previously it was you are under composition scheme, not filed 3 consecutive returns, but now that has been changed to, so not filed annual return within 3 months from the due date, then it will lead to cancellation of registration. So that is one point. Then yet another point is normal scheme, you are not filing returns. So here they have modified little bit and they are telling, so depending upon the period as may be prescribed, not file returns for a prescribed period. Accordingly in rules, they have given the period prescribed as, if you are under QRMP, quarterly return monthly payment scheme, continuous 2 quarters. Continuous 2 quarters if you are not filing return. If you are not under QRMP for a continuous period of 6 months, if you are not filing returns, then in that case they can initiate cancellation of registration. So the last 2 points are, so a person who is required to file returns under composition scheme not filed within 3 months after the due date, and a person who is required to file normal returns not file returns consecutively for 2 quarters or 6 months as the case may be. In these 5 cases, proper officer can initiate cancellation of registration. Have a look into these illustrations. Zen Solutions Private Limited, registered in Tamil Nadu, opted for composition scheme for the financial year 22-23, and they are required to file annual return in GSTR 4 by 30th April 2023, because next financial year by 30th is the due date of filing GSTR 4. If they are not filing GSTR 4 by 31st July within 3 months, so May, June, July, then their registration is subject to cancellation by the proper officer. Same way, another company, Apex Private Limited, registered in Karnataka, opted for QRMP scheme, has not filed returns, that is GSTR 3B, for the quarter July to September 2023. And what is the due date for that? Say 22nd October 2023. And next quarter, October to December, the due date is 22nd Jan 2024. Suppose if the returns are not filed, then after 22nd Jan 2024, they can initiate cancellation of registration. They will wait till the time due date. So 2 consecutive quarters, so returns were not filed. So then also they can initiate cancellation of registration. Yet another case, Patridge LLP, registered in Kerala, opted for monthly filing of returns and has not filed returns from June 2022 to November 2022. So, for November 2022, the due date is what, 20th December 2022. After 20th December 2022, they will initiate cancellation of registration because returns were not filed for a consecutive period of 6 months. Let's proceed to the next segment, that is payment process. In this segment, we have one major amendment, that is interest. So, interest under section 50. So, interest on account of delay in payment of tax, that is short payment of tax or non-payment of tax. And now, section 50 subsection 3 has been completely revamped, and in section 50 subsection 3, they have provided for wrong availment and wrong utilization of ITC. So, now when interest under section 50 will be applicable? Interest under section 50 is now applicable in two cases. So, number one, on account of delay in payment of tax, either non-payment or short payment. Second, on account of wrong availment and wrong utilization of ITC. Now, what is the rate of interest that is applicable? So, in section 50 subsection 3, that is on account of wrong availment and wrong utilization of ITC, even though the law provided for 24% per annum, but the words that are used in the law is for an amount, for a rate not exceeding 24% per annum. So, you can see here subsection 3, which says where input tax credit has been wrongly availed and utilized by the registered person, shall pay an interest on such ITC wrongly availed and utilized at such rate not exceeding 24% as may be notified, even though it is given as 24%, but as may be notified by the government on the recommendations of the council. Accordingly, in Finance Act 2022, in 6th schedule, it has been provided that the applicable rate of interest is 18%. So, due to that reason, so we take 18% only in all these cases. Okay. Now, so in case of delay in payment of tax, how interest needs to be computed? So, interest needs to be computed, so based on the date after the due date till the actual date of payment, the interest period is computed, and whether it should be computed on net liability or on gross liability. So, this confusion was even clarified in the last year itself, and therefore, for May 22 and November 22, we learned that provision only. So, that is situation number 1, GSTR 3B has been filed late. Now, in that case, whether we need to compute interest on the gross liability or on the net liability? On the net liability. What is the logic here? Because had you filed GSTR 3B on time, you would have paid net liability only. Suppose if you are delaying it and filing, then also you need to pay only on the net liability. That is, that amount which is payable using the cash ledger. For example, if the GSTR 3B liability is 50 lakhs, in that 50 lakhs, we have input tax credit balance of 30 lakhs and remaining 20 lakhs is payable using the cash ledger. Then in that case, for delay in filing GSTR 3B, interest needs to be computed only on 20 lakhs, but not on the entire 50 lakhs. That is the first situation. The second situation on account of delay in payment is that whenever we are required to report some liability in 3B and pay that liability, we are not doing it. Say, we have to pay 3 lakhs for an invoice, but that invoice is not mentioned in GSTR 3B. But that month we filed the GSTR 3B. Now, this invoice we will add at a later point of time and we will pay it either on account of demand and recovery under section 73 or 74 or on account of any reason. So, then in that case, this liability should have been paid for a month, but you did not pay for that month. Now, you are paying it late. When you are paying it late, can I pay it using both credit ledger and cash ledger? Yes. So this 3 lakhs I can pay using credit ledger as well as cash ledger. Now in that case, say 2 lakhs is paid using credit ledger and 1 lakh is paid using cash ledger at a later point of time. Now interest needs to be computed not on that money which is paid using cash ledger, but on the total amount of 3 lakhs. So that's where these two situations differ. Now there is a third situation, that is where section 53 has been provided, that is whenever we have wrongly availed ITC, whenever we have wrongly availed ITC and that wrongly availed ITC is utilized for payment of liability. Now interest is applicable on that portion of ITC which is utilized, not on which is availed, but on which that portion which is being utilized, on that only interest will be applicable. These are the three situations now we have with respect to interest under section 50. So now related to this third situation, what is the manner in which we can understand as to when it is wrongly utilized? For that purpose, they have given one new rule, that is rule 88B has been provided. What does rule 88B says? So let's try to understand here. You can see this third one, 88B sub rule 3, in case where the interest is payable on the amount of input tax credit wrongly availed and wrongly utilized. In accordance with 50 subsection 3, the interest shall be calculated on the amount of input tax credit wrongly availed and utilized for the period starting from the date of utilization of such wrongly availed ITC, date of utilization, till the date of reversal of such credit or payment. From the date of utilization till the date of reversal or payment. What is considered as the date of reversal or date of payment? It is simple. So for whichever month we file 3B, so in which we are doing the reversal or payment, that will be taken as the 3B filing date will be taken. And what will be taken as the date of utilization? For that purpose also they gave an explanation in the rule. So in that explanation, so the date of utilization of ITC, the date of utilization of ITC shall be taken as the date on which return is due to be furnished under 39, means due date of GSTR 3B of the month in which it is utilized, or actual date of filing GSTR 3B, whichever is earlier should be taken. Due date of filing GSTR 3B or actual date of filing GSTR 3B of the month in which that ITC is utilized should be taken as the date of utilization. And therefore, suppose if it is reversal, it is simple, the date on which we file the GSTR 3B of the month in which we are reversing the ITC or we are making the payment of that wrongly utilized ITC. Now, what is taken as the wrongly utilized ITC? That wrongly utilized ITC means what? How do we know that ITC has been wrongly utilized? For that amazing explanation has been provided. So they are little sensible here, that is input tax credit wrongly availed shall be construed to have been utilized when the balance in the electronic credit ledger falls below the amount of ITC wrongly availed. So now we need to understand as to what is the meaning of wrongly utilized. Wrongly utilized means first you have wrongly availed the ITC. That wrongly availed ITC, so the balance will fall below. Say for example, month 1 we have wrongly availed ITC to the extent of 2 lakhs and the correct ITC is 1 lakh. So therefore total ITC availed is 3 lakhs. And we have used wrongly availed 2 lakhs and correctly availed 1 lakh, total 3 lakhs. And we used 50,000. So what is the balance? 2,50,000. Whether the wrongly availed ITC 2 lakhs falls below? No, because the balance is 2,50,000 rupees. So there is no issue. That is the first case. So wrongly availed ITC 2 lakhs, correctly availed ITC 1 lakh and utilized 50,000. So what is the balance that is there? 2,50,000. So whether the balance has fallen below the wrongly availed ITC? No. So we have not used the wrongly availed ITC in this month. Now, second month, month 2. Month 2, so we have not availed any ITC. Already there is an opening balance of 2,50,000 rupees. Now, we have correctly availed 1 lakh, no wrongly availed, correctly availed 1 lakh, Already opening balance 2,50,000 is there. Correctly availed 1 lakh is there. 3,50,000 and we have used 1,50,000. So 1,50,000 when we use, what is the balance? 2 lakhs. Whether the wrongly availed ITC 2 lakhs has fallen below this in the balance, whether the balance has fallen below the wrongly availed ITC? No. So not utilized in the month 2 also. Month 3. In month 3, the opening balance is 2 lakhs. Month 3, the opening balance is 2 lakhs. And month 3, they have availed the correct ITC 50,000. They have correctly availed 50,000. So 2 lakh plus 50,000 and they have utilized 1,50,000. So therefore, what is the balance now? 1 lakh. 2 lakhs plus 50,000, they utilize 1,50,000. So therefore, what is the balance? 1 lakh. Whether the balance has fallen below the wrongly availed ITC? Yes. Wrongly availed ITC how much? 2 lakhs. So the balance has come down below 2 lakhs. To what extent? 1 lakh. So that 1 lakh is only called as the wrongly utilized ITC. So now that month in which, that is the third month, how much is wrongly utilized ITC? 1 lakh. And on that 1 lakh only interest will be computed. That too from when? For month 3, we will be filing one GSTR 3B. Either due date of GSTR 3B or actual date of GSTR 3B, whichever is earlier, will be taken as the starting date for computation of interest. Then, now we are reversing the ITC. Say in month 6, we are reversing the ITC. So now in that case, so we need to compute interest only on 1 lakh. Why we need to compute interest only on 1 lakh? Because we used only 1 lakh. We have not used entirely 2 lakhs. So that's how they have given the explanation here. So have a look into this explanation again. Input tax credit wrongly availed shall be construed to have been utilized when the balance in the credit ledger falls below the amount of ITC wrongly availed, and the extent of such utilization shall be the amount by which the balance in the electronic credit ledger falls below the credit wrongly availed. To what extent it has come down, that much only will be taken as the wrongly utilized ITC. So this is how we need to understand as to when it is wrongly utilized. Now, what are the 3 situations that are covered under section 50? Situation number 1, that is interest on account of delay in filing 3B. Situation number 2, interest on account of late payment of taxes. Then situation number 3, interest on account of wrong availment and wrong utilization of ITC. Now in these 3 situations, what is the rate of interest? 18% per annum. And in the first situation, interest is computed on net liability. And situation number 2, interest is computed on gross liability. And situation 3, interest is computed on only wrongly utilized ITC. Then next one is that what is the period for which interest is computed? In situation 1, situation 2, it is common. What is that? So it is from the first date after due date, that is after the due date till the date of payment. Whereas in situation 3, interest will be computed from the date of utilization till the date of reversal. What is taken as the date of utilization? Date of utilization is taken as the actual date of actual date of filing 3B or due date of filing 3B, whichever is earlier, and date of utilization, date of reversal, date of utilization till the date of reversal. So date of reversal will be taken as the date in which the month 3B has been filed for reversal or payment of ITC. So this is the snapshot with respect to interest computation. Now let's see some illustrations on computation of interest. Illustration number 1, gross liability for July 2020 is 8 lakhs and ITC availed in that month is 3 lakhs, and therefore the net liability is 5 lakhs, and that 5 lakhs has been deposited in electronic cash ledger as on the due date of filing GSTR 3B, that is 20th August. But the mistake what this person did is that he did not file the 3B, he just deposited that 5 lakhs into his cash ledger, but he filed the 3B for all these 3 months on 28/12/2020. So even though he deposited the money into the cash ledger, whether interest will be applicable? Yes, interest will be applicable, because what is considered as the date of payment? The date on which 3B is filed is only considered as the date of payment, but not the date on which he deposits money into the cash ledger. So due to that reason, so interest is applicable in this case, but interest is computed only on the net liability, because this is on account of delay in filing 3B. So therefore interest is computed on net liability. So net liability is what? 5 lakhs. So interest is computed only on 5 lakhs. From when to when interest will be computed? So interest will be computed on 5 lakhs from the first date after due date, that is from 21st August till the date of payment. What is the date of payment? Say for 3B, he filed on, for the above months, he filed on 28/12, means that is taken as the date of payment. So till 28/12 it will be computed. So therefore the period for which interest is computed is 130 days, and for 130 days 5 lakhs into 18% into 130 divided by 365. So therefore 32,055 will be taken as the interest payable with respect to this July month liability. Then second, for the month of August also, if you see, 4 lakhs is the liability, ITC availed 1 lakh, the difference is 3 lakhs, he deposited that 3 lakhs, how already 5 lakhs is there, he deposited 3 lakhs, so that comes to 8 lakhs on 29. But even then, interest will be applicable starting from 21/9 till the date of payment, that is till 28/12, that is 99 days. For this 99 days, interest will be computed. Same way, third scenario, that is GSTR 3B of September 20. So gross liability 6 lakhs, ITC availed is 4 lakhs. So the difference is 2 lakhs. That 2 lakhs is deposited on 2010. So the balance came to 10 lakhs. Again on this 2 lakhs, interest needs to be computed at 18% per annum. So from which date? From the date of, from the first date after due date, that is 21st November 2020 till the date of payment, that is 28/12/2020, 69 days. For the 69 days, it comes to 6,805 rupees. Then second illustration, PQR Limited have filed their GSTR 3B return for the month of August 2022 within the due date, that is 29/22. It was noticed in October that tax dues for the month of August have been short paid by 10,000 rupees. So there is a short payment of 10,000 rupees. That shortfall of 10,000 was paid through cash ledger and credit ledger, 7,500 and 2,500 while filing 3B of October 2022, which was filed on 20/11/2022. Examine and compute the interest, if any, under the CGST Act 2017. Now, this is, we have to pay liability for a particular month, and we did not pay it for August month, but we paid at a later point of time in GSTR 3B of October, which was filed on 20th November. Now, on entire amount, on the gross amount, this is the second situation, on entire amount, interest will be computed. So here interest will be computed on 10,000 rupees, not on that amount which is paid through cash ledger on entire 10,000. From when? So this pertains to which month? August month. So for August month, what is the due date? So 20th of August, 20th of September. So from 21st September till the date of payment, that is 20 November. So for the 61 days, it will be computed. So therefore, that comes to 301 rupees as the interest in this case. Then second situation is that what will be your answer if GSTR 3B for the month of August has been filed belatedly on 2011? Now in that case, on this 10,000 rupees, interest will be payable not on entire 10,000, only on that portion which is paid using the cash ledger, because there is a delay in filing 3B. So therefore, how much is paid using cash ledger? Paid through cash ledger and credit ledger, 7,500, 2,500. Only on 7,500 interest will be computed. So same way, 7,500 into 18% into 61 divided by 365. So that's how the interest will be computed in this case. So that will come to 226 rupees. Let's see the third illustration. Mukund traders registered in Gujarat have opted to file returns on a monthly basis, and for all the months they file GSTR 3B on 18th of the month following every month. For the month of October 2022, they have wrongly availed 1,50,000 rupees and reversed the same in January 2023. So when they have wrongly availed in the month of October 2022, they have wrongly availed and reversed the same in Jan 2023. Their tax consultant is of the view that interest is not payable on account of Finance Act 2022 amendment. You are required to compute interest payable, if any, based on the following information. So we have got the information here. First, September month, if you see September 2022, because so here they have given, so on a monthly basis for the month, they file GSTR 3B on 18th of the month following every month. For the month of October, So they have given some September data also. September opening balance of ITC 3 lakhs, ITC availed 2 lakhs, ITC utilized this for payment of liability 4 lakhs, still there is a balance of 1 lakh. October month 1 lakh and 5 lakhs is the ITC availed. In that 5 lakh there is a wrongly availed ITC. So this 1,50,000 is present in this 5 lakhs, okay, and they are utilizing it for payment of liability, the balance. Now, see October month, what is the balance? 3 lakhs, 3 lakhs. What is the wrongly availed ITC? 1,50,000. Whether the balance has fallen below 1,50,000 in the month of October? No. Again, November month, 3 lakhs, ITC availed, ITC utilized for payment 4 lakhs and closing balance is 1 lakh. Whether the balance has fallen below the wrongly availed ITC? Yes. To what extent? To the extent of 50,000 rupees. To the extent of 50,000 ITC utilized. In which month wrongly availed ITC is utilized to the extent of 50,000? In which month? In the month of November 2022. Then again December 1 lakh and 2,50,000, 1,50,000 utilized, so 2 lakhs, and thereafter January, whether the balance has fallen below? No. And January 2023, 2 lakhs and ITC availed 1 lakh, ITC utilized for payment 3 lakh. In that 3 lakh, 1,50,000 wrongly availed has been used, like reversed. So therefore, ITC balance has become 0. Now, what is the date of utilization? It is November 2022 is the month in which it is utilized. And what is the month in which it is reversed? Jan 2023. Now, interest period will start from when? Interest period will start from the date of utilization. What is the date of utilization? The date of utilization is the due date or actual date, whichever is earlier should be taken. So, what is the due date for November 22? The due date is 20th December. But what is the actual date? Here usually they file by 18th of the month following every month. So therefore, we will take 18th December till the date of reversal. What is the date of reversal? January. For January, they will file 3B. When that will be filed? So 18th February. 18th December 2022 to 18th February 2023. We need to compute the interest for this period. And that interest will be at what rate? 18% per annum. You can see the answer here. So, interest will be computed from 18 December 2022 to 18 February 2023, that is 62 days on 50,000 rupees only, because to that extent only it is wrongly utilized. So, 50,000 into 18% into 62 by 365. So, 1,529 will be taken as the interest. So, what we need to write first? First, as per section 50, subsection 3, read with rule 88B of CGST rules, interest on account of wrong availment and utilization is payable at 18% per annum. Then, ITC shall be considered to be wrongly availed and utilized if the balance in electronic credit ledger falls below wrongly availed ITC of 1,50,000. Also, the wrongly availed and utilized ITC is the extent to which such balance falls below 1,50,000. Therefore, in the present case, in November 22, the balance falls below 1,50,000 to the extent of 50,000 and interest is payable on that. Then, what is taken as the date on which it is wrongly utilized? That is interest computed from 18 December being actual date or due date, whichever is earlier, till the date it is reversed. So, this is how we need to present the answer. I am pretty much sure that this question will definitely be tested for May 23 exam, because I am sure, like last attempt also I said, for November 22 exam, one question on section 129 will come, that is related to penalty, and it came. For November 22 exam, it came for 5 marks. So, I am pretty much sure this interest computation question will be definitely tested for May 23 exam. I am sure about it, because this is one big amendment. So, definitely that can be tested for May 23, and this is how the illustration you need to answer. One more illustration on this wrong availment and utilization. GSTR 3B for July 2022 filed on 12th August 2022, where gross liability is 12 lakhs and ITC is 18 lakhs. Wrongly availed ITC of 2,50,000 during July reversed in GSTR 3B of December. and there are no transactions during August 2022 to November 2022, which means, so they have availed and they are reversing. There are no transactions during the period August 2022 to November 22, which means they will not be utilizing at all. That is July, there is no opening balance. They availed 18 lakhs. In that 18 lakhs, wrongly availed is 2 lakh 50, and they used for payment of liability 12 lakhs. So what is the closing balance? 6 lakhs. Whether the wrongly availed ITC has been utilized? No. Why it is not utilized? What is the wrongly availed ITC? 2 lakh 50. What is the closing balance? 6 lakhs. Whether the balance 6 lakhs has come below 2 lakh 50? No. So it is not utilized. Again, the next transaction is in December. In December, what they are doing? They are reversing. Opening balance 6 lakhs and they are reversing the wrongly availed ITC 2 lakh 50, closing balance 3 lakh 50, which means that they have not utilized at all. When they have not utilized at all, so why interest will be applicable? Interest will not be applicable in this case, because only when the wrongly availed ITC, if utilized, then only interest is payable. Next illustration 5. So in similar line to illustration number 4, what will be your answer if the wrongly availed ITC is 8 lakhs? Now, for the month of July, total ITC availed 18 lakhs. In that wrongly availed ITC is 8 lakhs. Now, utilized for payment of liability 12 lakhs. So, closing balance 6 lakhs. Now, whether the closing balance of ITC falls below the wrongly availed ITC? Yes. To what extent? 2 lakhs. So, therefore, what is the wrongly utilized ITC? 2 lakhs. For which month? For the month of July. So, for July month, so we need to calculate the interest from the date when return is filed for July month till the date of reversal, that is for December month. And what is the due date of GSTR 3B of July month? That is 20th August. And here, so we are taking as 20th August. Okay. Suppose if the actual date of filing is given, so that we will take. Okay. So if it is given, so actually in the previous question it is given as 12th August. So then we will count from 12th August. Suppose if it is not given, then we will count it from 20th August till the actual date of, no, actual date is not given, so till the date of reversal. What is the date of reversal? For December 22, when we will file, so 20th January, so till 20th January 2023, interest will be computed only on 2 lakhs at the rate of 18%, that is on the ITC that is wrongly utilized, but not on the ITC that is wrongly availed. Only on that portion which is utilized we need to compute, okay. And here, so interest is applicable only in case of wrong utilization of ITC. So that clarity we need to have. One more aspect here is that should we count the date? That is when we count 20th, here if you see 20th August to 20th January 2023, whether we need to count 20th August, no need to count 20th August. Why? Because usually we will not count that date, we will count from the next date. So even for normal interest also we will do the same way. So that's why we are doing the same way here. So maybe if ICAI gives any other question answer, so if they say that that date also should be taken, then that date also should be taken. Otherwise, usually we will count interest from the next day only. So therefore, we will count it here from 21st August. So even though it is given this way, but usually we will count it from 21st August. That's how it will be computed. Let's see the next amendment in payment process segment, that is recredit of erroneous refund claimed on account of zero rated supplies. In case of zero rated supplies, there are two options available to a person. Number one, whenever he makes a zero rated supplies, he can make zero rated supply without payment of tax and get the refund of unutilized ITC. The second option is refund upon payment of IGST, that is export zero rated supplies upon payment of IGST, and so much of the IGST paid he can get it as a refund. In these two cases, if he is getting erroneous refund, he is not supposed to get the refund, he gets the refund. Now that refund he is getting from the credit ledger. So that is refund of unutilized ITC. He will be given as a refund. Now that ITC balance will come down, and to that extent he will be getting that as money into his bank account. Now at a later point of time, so department has identified that this refund what he got is erroneous, or he himself identified that during audit or any other activity that this refund whatever he got is erroneous, he should pay back that amount along with interest and penalty. So interest computed from the date he got the refund till the time he is paying back the refund, and the penalty. So we have, if the demand is initiated under 73-74, that penalty, or the general penalty as the case may be. If he makes the payment of that penalty, then in that case, whatever refund that he has got, he is paying back. So that amount will go to the electronic credit ledger as a recredit. So first, in electronic credit ledger on the credit side, so there is some ITC balance. The moment he claim refund, that makes a debit to the electronic credit ledger. Now he is returning that refund, so that amount will go as a recredit to the electronic credit ledger. So that's how it will work. And for that purpose, what is the order that will be passed by the officer for recredit into electronic credit ledger? That order is in PMT 3A. PMT 3 capital A. A new form has been introduced in payment process. Form GST PMT 3A is that new form. So in this form, so there will be payment, that is recredit order, that will be done after making the payment. And what is the procedure for that? So for that, they have specified that the payment should be made through DRC3. As it is a voluntary payment, the payment should be made in DRC3. So in the DRC3, the reason, so the moment we look into DRC3, so we need to select the reason for payment. Okay. So in that reason for payment, it should be cause of payment. So how to access this DRC3? So once you log into the portal, so in dashboard under services, user service applications, intimation of voluntary payment. In that intimation of voluntary payment, cause of payment. This is the form GST DRC3. So here, so what is the cause of payment and under which section? What is the date, financial year? How much is the amount of tax, interest and penalty that is payable? So once we complete this payment, what will happen? So thereupon, proper officer will be passing a recredit order. That recredit order will be passed in, so PMT 3 capital A. But till the time this functionality is enabled in the portal, so they have given a circular. What is that circular says? Till the time this automatic functionality is enabled, a taxpayer has to make a return request. Once the payment is made in DRC3, so a return request has to be given, because at present in DRC3, in the cause of payment, we don't have this option. So we need to select others and we need to make the payment, and we need to give a return request in annexure A given in the circular, that so we are making the payment because of erroneous refund, etc. So then the proper officer will pass an order under PMT 3A for recredit within 30 days from the date of receipt of return request or date of payment in DRC3, whichever is later. So the time limit you need to remember, 30 days from the date of receipt of return request or date of payment in DRC3, complete payment in DRC3, whichever is later, within the time limit. So that PMT 3A order will be passed for recredit into electronic credit ledger. The next amendment is the modes of deposit into the electronic cash ledger. So what are the various modes that we already had? So we had net banking, debit card, credit card, and then NEFT, RTGS, then over the counter payment. Now to this list of payments, they have added even UPI and IMPS. So United Payments Interface and Immediate Payment Services, IMPS. So this is also added. So now we have in total 6 modes of deposit into electronic cash ledger. What are those 6 modes? Internet banking, net banking. Number 2, debit card or credit card. Number 3, NEFT, RTGS. Number 4, OTC, over the counter. And over the counter is limited up to 10,000 rupees per tax period. And the next one is UPI and IMPS. So these are the 6 modes of payment into electronic cash ledger. The next amendment is related to PMT 9. So PMT 9 form facilitates transfer of balances in the cash ledger from one cell to another cell. In the electronic cash ledger, we have a 20 cell matrix. We have 4 major heads: CGST, SGST or UTGST, IGST, and compensation cess. 4 major heads. Under these 4 major heads, we have 5 minor heads: tax, interest, penalty, fee, and others. So now, whenever we make a deposit into the electronic cash ledger through PMT6 challan, we need to mention properly under which minor head of major head we are making the deposit. Say we deposited in certain cells and that gets reflected into electronic cash ledger. Now we have made a wrong deposit. We need to shift the balance from one cell to another cell. So yes, that is possible through PMT9. Form GST PMT9. Using that, we can shift the balances from one cell to another cell in the electronic cash ledger. Now they have extended the facility of PMT9 even for shifting the balances from electronic cash ledger of one distinct person to electronic cash ledger of another distinct person. So for example, A Limited is having 2 companies or 2 entities. A Limited is having 2 entities, one in Tamil Nadu and another in Andhra Pradesh. Now these 2 are distinct persons of A Limited. Now in Tamil Nadu electronic cash ledger, Tamil Nadu GST and electronic cash ledger, there is some balance. Now that can be shifted to electronic cash ledger of Andhra Pradesh GSTIN, provided whatever liability that is there in Tamil Nadu has been paid. So for that month, the GSTR 3B has been filed, the liability has been discharged and there is an excess balance that can be shifted to Andhra Pradesh GSTIN. So how this can be done? Through PMT9. So now PMT9 has been extended to shift the balances of cash ledger between distinct persons also. Next one is a small amendment. This is related to adding restrictions in section 49. That is, we have 2 rules, Rule 86A and Rule 86B. Rule 86A says that whatever balance that is there in electronic credit ledger can be suspended by the proper officer for a period of 1 year. So if the supplier is not in existence or recipient is not in existence or not doing business from the place where they have obtained registration, or invoice, without invoice they have availed ITZ. So like that, some cases 86A there are some restrictions, and 86B also there is a latest restriction that whatever is your liability, that liability 99% only you can pay through credit ledger and 1% has to be paid through cash ledger if your turnover in a month exceeds 50 lakhs. But these 2 rules ultraviolate the act actually, because nowhere in the act there were restrictions for the purpose of utilization of ITC. So many writs were filed in the high courts. Due to that reason, now they are making an amendment wide Finance Act 2022 in section 49 itself, wherein in section 49 it is given that the amount available in the electronic credit ledger may be used for making payment towards output tax under this act or IGST Act or SGST Act, subject to such conditions and restrictions. Subject to such conditions was there previously, but now they have added subject to such conditions and restrictions within such time as may be prescribed. So therefore, now Rule 86A and 86B has got the validity through this amendment in section 49. We have few circulars related to this payment process segment. That is, there were disputes about payment of electronic credit ledger balance for liability, tax liability determined under section 73 and 74. So whenever a registered person has not paid the tax or short paid the tax or wrongly availed, utilized the ITC or erroneous refund, so department can issue a notice and recover the amount of tax through 73 or 74. These 2 sections are there. So upon issuance of notice or demand order, the registered person is required to make the payment of tax. Now the issue is, can the tax be paid using credit ledger balance? So for that, CBIC has given a clarification that the balance available in the electronic credit ledger can be used for payment of self-assessed tax in the return, or payable as a consequence of any proceeding instituted under the provisions of GST law, which means not necessary that only when you are filing 3B you can use the credit ledger balance for payment of your liability. Even at a later point of time also, whenever the demand order is served upon you, if you have that much of electronic credit ledger balance, that can be used for payment of tax under demand or adjudication order in terms of 73, 74. So for that they gave one clarification. And the next issue is whether the balance available in the electronic credit ledger can be used for payment of any liability other than the GST law. So no, so it is any other amount here refers to any other amount under the GST law. So any other amount that is given in section 49 should not be interpreted as any other amount under any law for the time being in force. The balance in the credit ledger can be used only for payment of tax under GST Act. So any GST Act, but it does not mean that it can be used for payment of income tax or it can be used for payment of customs duty, etc. Then the last clarification, which is a well-known clarification, that can we use it for payment of any other amount? No. So here any other amount is given as a prefix to tax. So which means that any other tax. Why they have given any other tax? Which means that, so under SGST tax or IGST tax, for that only we can use. We cannot use it for payment of interest, penalty, fee and others. So that's the clarity given through the circulars. Hi friends, now we are going to see amendments in the next segment, that is returns under GST. So in this returns segment, there is a big important change that has happened, that is with respect to section 38. So section 38 was previously related to statement of inward supplies. So that was given in GSTR 2. But now because there is no GSTR 2 and GSTR 3, so completely this returns under GST chapter, there are many sections that are omitted and few sections were substituted and some amendments have taken place. Now we are looking into the first section, that is section 37. Section 37 talks about details of outward supplies in GSTR 1. So every registered person is required to give the details of their outward supplies in GSTR 1, and that details will be communicated to the recipient. And now in this section 37, the first subsection, they have just given that subject to such conditions and restrictions, so that if at all GST department wanted to add any restrictions onto this GSTR 1, they can add that. So that's the reason why they have given this. So this is not a great amendment. So just subject to such conditions and restrictions has been added. However, so there is one proviso which was now there in the previous section 37, which is now omitted. So what is that provision? So it says that provided that the registered person shall not be allowed to furnish the details of outward supply during the period from 11th day to 15th day of the succeeding month. So why? What is the due date of filing GSTR 1? The due date of filing GSTR 1 is 11th of the month following every month. So between 11th to 15th, suppose if you miss the 11th deadline, so can you file the details of outward supplies in 12, 13, 14, 15? No, that will not be possible. So that restriction was there. And previously that restriction was given because there were GSTR 2, GSTR 1A, GSTR 3, like that concept. But now that is not there. So therefore this proviso is of not required. So completely this proviso is omitted. So which means now a person, if he misses the deadline of 11th of the month following every month, he can even file the return on 12th, 13th, 14th also, there is no restriction. But what is the disadvantage if a supplier furnishes the GSTR 1 after the due date, that is after 11th? There is a big problem here that if he is filing the GSTR 1 after 11th, then the details will not be reflected in GSTR 2B to the recipient. For example, there is one supplier and that supplier has filed GSTR 1 by 11th of July with respect to June month. Now, these details will be made available to the recipient in GSTR 2B for the month of June. So, the recipient for the month of June will get the details of these invoices which were uploaded by the supplier in GSTR 1 filed by 11th. Suppose if the supplier files GSTR 1 after 11th, say 12th, 13th like that, after 11th if he files, then it will be made available to the recipient not for the month of June, but for the month of July in GSTR 2B of the recipient. Means, so this cannot be availed as ITC by the recipient in the month of June, even though it pertains to June month, but he cannot take ITC in the month of June, he can take ITC only in the month of July. So that is the risk that is involved. So now the recipient should be aware that, he need to ask the supplier, boss, please file your GSTR 1 by 11th. Okay, sir, we added the invoices. That is not sufficient. Okay, fine, you added the invoices, which I can see in my GSTR 2A. The moment supplier add the invoice in GSTR 1 but not file, that we can see in GSTR 2A. I don't know how many days GSTR 2A is going to be, but yes, respective, at present we can see that he has added invoices, but that is not just sufficient. So he should ensure that, that is recipient should ensure that the supplier is also filing the GSTR 1 by the due date, then only that comes in 2B. Suppose if the supplier files those in GSTR 1 at a later point of time, unnecessarily the recipient has to wait for 1 more month to receive that credit. So the cash flow gets affected. So that's the reason why. So we should be ensuring that the supplier is filing the GSTR 1 by the due date. Then, so there is no restriction now that he can file even after 12th, 13th, 14th, any day. Previously that was there and that proviso has been omitted. The next amendment is with respect to section 37 omission, that is previously, so the detail should be made available to the recipient, and if the recipient is not agreeing to those details, he may accept or reject, like that one concept was there. That is, the moment we file GSTR 1 as a supplier, that will be made available to the recipient, and recipient can check that and he can reject the transactions, like that it was there. Now there is nothing like that. So that's why completely that subsection 2 has been omitted. Then they added one new subsection, that is subsection 4. And what does that subsection 4 says? That a registered person shall not be allowed to furnish the details of outward supplies for a tax period if the details of outward supplies for the previous tax period has not been furnished. For example, if for the month of September GSTR 1 is not filed, then for the month of October GSTR 1 cannot be filed. So first file the GSTR 1 of September and then only you can file the GSTR 1 of the October. So this was by way of rules, but now they have brought in into the section itself. So without filing GSTR 1 of the previous month, I cannot file the GSTR 1 of the current month. That is the point. However, in cases where the officer, GST officer permits, can we file the GSTR 1 of a tax period even without filing the GSTR 1 of the previous tax periods? Yes. So that is possible. So that is also given in subsection 4. Provided that government may, on the recommendations of the council by notification, subject to certain conditions and restrictions as may be specified therein, allow a registered person to furnish the details of outward supply even if he has not furnished the details of outward supplies for 1 or more previous periods. So that power is there with the government to notify, but otherwise without filing GSTR 1 of the previous month, I cannot file the GSTR 1 of the current month. So these are the amendments in section 37. Then the next section is section 38. Section 38 was previously, so communication of details of inward supply, statement of inward supply to the recipient. Now also they have maintained the same heading, communication of details of inward supplies and input tax credit. So this section 38, the old section 38 was completely omitted, and in that place they have added new set of provisions. For the sake of understanding, we are trying to see the bare act of section 38. So in this subsection 1, if you see, the details of outward supply furnished by the registered person under subsection 1 of section 37, that is GSTR 1, and such other supplies as may be prescribed. and an auto-generated statement containing the details of input tax credit. What is that auto-generated statement? GSTR 2B. So, shall be made available electronically to the recipients of such supplies in such form and manner and within such time, subject to such conditions and restrictions as may be prescribed. Accordingly, the relevant form for this purpose is GSTR 2B, and this GSTR 2B will be made available to the recipient after 13th, okay, after 13th of the month following every month. Why 13th of the month following every month? 13th of the month following every month. Why like that? Because what happens is that, so whenever IFF is required to be filed by the supplier, okay, GSTR 1 is by 11th, but under QRMP, GSTR 1 will be filed by 13th of the month following every quarter. Moreover, for the first and second month, so IFF, Invoice Furnishing Facility, needs to be filed. So that is optional, of course, but that will be filed by 13th of the month following every month for the first and second month. So that's the reason why now they have made it as 13th. So this GSTR 2B will contain the details of input tax credit. And this GSTR 2B will have two aspects. One is ITC available and ITC not available. So there will be two aspects in GSTR 2B: details of inward supplies in respect of which credit is available, in respect of which credit cannot be availed. So why credit cannot be availed? Maybe even though it is reflected in GSTR 1 filed by the supplier, even though it is reflected in GSTR 1 filed by the supplier, but ITC may not be available to the recipient. What could be the reason for ITC not available to the recipient? Suppose if the supplier is taking registration, so and immediately within a prescribed period after registration, so that details cannot be made available to the recipient in GSTR 2B, but even if the GSTR 1 details are filed, but 2B credit is disallowed. Newly registered suppliers. So this for the newly registered suppliers. By any registered person who has defaulted in payment of tax and where such default has been continued for such period as may be prescribed. So what is the reason for prescribing this first point? The first point reason is that newly when I register, I will file GSTR 1, but I will not be filing GSTR 3B. So to discourage the credit that is taken on these suppliers, so that's the reason why they are telling that a newly registered supplier, he mentioned the detail in GSTR 1, we will not give it to you. We will give you later whenever he files GSTR 3B. So that restriction they wanted to keep. That's why that first point has been given. Second point, if you see that who defaulted in payment of tax. So now it is a very important point that you all should know that can a recipient take ITC as per GSTR 2B even though supplier has not paid the tax? Yes, because supplier, the moment supplier files GSTR 1, that comes in GSTR 2B, but if the supplier has not paid the tax, even though it comes in 2B and you took the ITC, but that may be given as ITC not available. So which means automatically whatever ITC that is not available reflected in GSTR 2B will be reversed. So will be deducted from the ITC avail. So therefore this particular point we should be careful that supplier has not paid the tax. Then recipient, whatever ITC that is reflected in 2B may be disallowed. That is that second point. Then third point, if you see, by any registered person, the output tax payable by whom in accordance with the statement of outward supplies during such period exceeds the output tax paid by him during the said period by such limit as may be prescribed. That is, the liability in GSTR 1 is greater than, the liability in 3B. When that will happen? I have added many invoices in GSTR 1, but all invoices I did not pay in GSTR 3B. So that is what, and normally it so happens, sir. So okay, permissible limit, within that permissible limit, say 5%, 10%, that is allowed. But beyond that, it will not be allowed. So beyond that, if it happens, then they can restrict that ITC. Then next point, what we have, point number 4, by any registered person who during such period as may be prescribed has availed credit of input tax that exceeds the credit that can be availed by him in accordance with clause A by such limit as may be prescribed. What does it mean? Which means that ITC in 3B is greater than ITC in 2B. the ITC that is availed in GSTR 3B is greater than the ITC availed in 2B, that ITC that is reflected in 2B. Now here comes the another important question. What is that? Can I take in 3B more ITC than in 2B? Already we discussed this amendment in input tax credit segment. What is that I told you? The ITC that can be availed by a recipient is matched ITC as per 2B minus blocked credits, ITC with respect to non-business, ITC with respect to exempted, and we need to add GST paid under RCM. So, self-assessed ITC is what we take. So, this self-assessed ITC, so it so happens that GST paid under RCM, so we have taken more. So, then whatever ITC that is reflected in 2B and what is the ITC that is taken in 3B is say more. Okay, within the permissible limit. If it is within the permissible limit, fine. Otherwise, then also the ITC may be restricted. Then the next point, by any registered person who has defaulted in discharging his tax liability in accordance with the provisions of subsection 12 of section 49 and subject to such conditions and restrictions as may be prescribed. Okay, so that is he has not paid say 1% of the liability through electronic cash ledger. So, or any such restrictions which are placed, but he did not follow that restrictions by such other class of persons as may be prescribed. Now, based on that, I just gave you one example. So, let's see before this section 38 how the situation was. Total ITC as per books is 10 lakhs, whereas ITC in 2B filed by the suppliers was 8 lakhs, and in that eligible ITC in the 2B is 6 lakh 50. So, how much ITC we can take? 6 lakh 50 we can take. But now, after amendment, that is not just 6 lakh 50, suppose if that is disallowed. Why? Because supplier is a newly registered person, or supplier has filed their GSTR1 but not filed 3B. So, then take out. The supplier liability in GSTR1 is greater than in 3B. That may also be given as ITC disallowed. Then, supplier has received demand notices and defaulted in payment of taxes and the default continues. Then, supplier has not fulfilled the conditions of Rule 86B. So, like this, whenever there is a restrictions like this, whatever restrictions we have seen, in all these ITC disallowed, the remaining balance 3 lakh 30 that can only be taken. So, here these are all the restrictions that can be put forth by the department. So, even the matched ITC may be disallowed in terms of section 38. Many times I tell in the class that this ITC is like, a hero, mythological hero, Karna. So, in Mahabharata, you would have come across one character by name Karna. So, ITC is like Karna only, because many kind of hurdles that Karna will undergo as soon as he is born. So, he will be deserted and he will be sent in the water, in the river by his mother, and he will be growing in someone's home, and thereafter, so when he tried to learn, people will not be willing to teach him because he belongs to the lower caste, and thereafter he will be trying to prove his mettle in the testing phase between Pandavas and Kauravas. There also he will be insulted, and then he will try to learn the whatever that astras, shastras, etc. and from Parshurama, Lord Parshurama, but Parshurama will curse that, you will not be able to remember this because you are not a Brahmin and you lied to me that you are a Brahmin like that. So, therefore, that you will forget. And there are many such curses. After all these hurdles, he will come and stand in the battle. So, even then, Krishna will use his, tricks and he will ensure that he is getting killed. Like that, my money, sir, I wanted to take that as ITC, but see how many restrictions: blocked credit not available, used for exempted not available, and section 16 conditions: you should be in possession of tax invoice, your supplier should have paid the tax, you should have filed the return, you should have received the goods. Then again, payment process, certain restrictions are there, like 1% you have to pay by cash ledger fully, you cannot use credit ledger. And suppose if the supplier is not doing business from the place where they have obtained registration, that will be suspended for a period. And now this section 38 restrictions. So this many hurdles I have never seen. And after all these things, the ITC that you take, so see the invoices. The invoices is what? The invoices here is 10 lakhs. But what I get in my hand is 3,30,000. So this is stupidity. So from 10 lakhs, total 10 lakhs, what I am getting in my hand is 3,30,000. So this unfortunate situation, and this is how they are tightening that input tax credit. And I don't feel like, what's the point in calling that we are having a system of credit in indirect taxes now in GST, which was a lot of restrictions before. Now also there is restrictions. So free flow of credit is the motto of the current government, but somewhere, it missed. Okay, that's my pure opinion. So I'm not talking about politics, I'm talking about the policies here. So this is something which is not at all correct. Then the next section in return segment is section 39, that is furnishing of returns. So mainly in section 39, they're talking about GSTR 5, 5A, then even 3B, all those returns related information is given in section 39. There are few amendments in section 39. In that, the first amendment is that GSTR 5 is a return that will be filed by non-resident taxable person. NRTP, non-resident taxable person, is a person who come from outside India to India and is making supply of goods or services in India and is not having any physical place of business in India, and his coming to India is on an occasional basis, is called as a non-resident taxable person. This non-resident taxable person is required to file a return, monthly return in GSTR 5. And this GSTR 5, before amendment, the time limit was 20th of the month following every month, or 7 days from expiry of registration, whichever is earlier. Now, this 20th has been changed to 13th. So, that is the revised time limit for GSTR 5, 13th of the month following every month, or date on which registration gets expired, plus 7 days from expiry of registration, whichever is earlier will be taken. So what is this expiry of registration? We all know that NRTP will have a temporary registration, and so that registration is for a period up to 90 days, or it can be extended for a further period not exceeding 90 days. So there is a temporary registration only for them. That's why 7 days from expiry of registration. The next amendment in section 39 is related to, so return which is required to be filed, so under GSTR 3B, that is section 39 GSTR 3B. So whether they need to pay the taxes, if they are opting for QRMP, whether they need to pay taxes as per fixed sum method or self-assessment method. So for that, it was only in the rules, it was not given in the section. So that's why they have made an amendment in the section itself stating that a person who is opting to pay GST on a monthly basis but filing returns on a quarterly basis, QRMP, may either pay tax as per system calculated, that is fixed sum method, or self-assessment method. So they have option to choose. And next one is with respect to the time limit for rectification of GSTR 3B and GSTR 1. So section 37 as well as section 39, both places this amendment is there. So in similar time limits, we have already discussed this, that so rectification of GSTR 1 as well as rectification of GSTR 3B, now the time limit is what? 30th November of the succeeding financial year, or date of filing annual return, whichever is earlier. Then next is with respect to few sections like section 42, 43 and 43A, which was talking about matching, reversal and reclaim of ITC, that was related to the earlier return filing process. So these three sections are omitted, 42, 43 and 43A. These three sections were omitted. Then yet another amendment in section 47, late fee. So already late fee has been completely revamped, which was an amendment for the previous exam, November 22 exam itself. Now what they are telling is that the late fee, there was a confusion. For GSTR 8, they have not given any late fee in the law. That's why this section 47 has been amended to incorporate the late fee even for GSTR 8. What is GSTR 8? A return which will be filed by a TCS deductor, e-commerce operator. So what is a late fee for that? 100 rupees per day subject to maximum 5,000. So that late fee is now prescribed even for GSTR 8. That is one small amendment. Then to whom annual return is now applicable? Annual return is required to be filed in GSTR 9 or 9B by any registered person whose aggregate turnover exceeds 2 crores. So this they were continuing from 2017-18, from 2017-18, 18-19, 19-20, 20-21. Now latest for 21-22 also they have given a notification stating that if annual aggregate turnover in a financial year exceeds 2 crores, then only you are required to file annual return, otherwise not required. Like that they gave this notification, and future we can expect that forever they may bring this into the section, but right now it is in the form of a notification up to the current financial year 2021-22. Then in GSTR 3B, so in the form they have made some amendments wide in notification. The first amendment is that whenever I am making supplies through e-commerce operator, the liability to pay GST is on e-commerce operator under section 9 subsection 5. So there are 4 services which will be supplied through e-commerce operator. There is a supplier, there is a e-commerce operator, and there is a recipient. So what are the 4 services supplied through e-commerce operator? HATE, housekeeping service, accommodation services, transportation by any motor vehicle, and eating food from a restaurant. These 4 services supplied through e-commerce operator, liability to pay GST is on e-commerce operator. Whether the supplier has to declare these outward supplies? Yes. In 3B, the supplier is required to declare these outward supplies. For that, in 3B table 3, they have added one new row stating that any supplies through e-commerce operator under section 9.5 for which liabilities on e-commerce operator should be separately shown there. And one more update in form 3B is that the reversal of ITC. So in ITC table 4 ITC we have, in that they are telling that ITC reversal also includes ITC reversal in terms of rule 38, that is for banking company, financial institution, etc. So what we need to do is that previously we used to take only 50% of the eligible ITC, but now they are telling show full ITC and then you do the reversal of 50%, including blocked credits, etc. Then one new row has been added in table 4D, that is ineligible ITC has been changed to other details. So in that other details, so not only ineligible ITC but any other case. So because place of supply, because we already know that if it is CGST, SGST paid in the other state, we cannot take it as ITC. That information also will be reflected there. But I doubt whether this will be applicable for exam or not, this amendment, because this is a practical amendment related to form GSTR 3B. I doubt whether this will be applicable for exam or not, but as it is there, I have just given. As on the date of release of these amendments videos, ICAI has not released any amendments material. So if ICAI releases any amendments material, so in that case, so those amendments only will be applicable, but usually majority of the amendments, whatever I have compiled, is based on the notifications and circulars, and it is subject to change. If ICAI omits certain amendments, then it will not be applicable. But if they add any amendments, so definitely I will make a video on that and I will be uploading it as to what are all the amendments which ICAI has omitted, so in their amendment book, and what are the new amendments, because so usually new amendments there is no possibility, only existing amendments will be removed. So but new amendments will not be added because I have compiled everything. Let's proceed to the amendments in the next segment, that is demand and recovery. In this demand and recovery, so far, like from after returns chapter up to demand and recovery, there are no amendments. in assessment and audit, accounts and records, and then offences, penalties, search, seizure. So up to segment 17, there are no amendments, but in segment 18, demand and recovery, they have given a circular giving certain clarifications with respect to issuance of notice and recovery in terms of 73 and 74. Let's try to understand the first issue. There is Amar, who is a supplier, and that Amar is making supply to Mr. Balaji, a recipient. And so here what Amar is doing, Amar is raising invoice to Balaji, but Amar is not making any supply of goods or services, just the invoice has been raised to Mr. Balaji, supply is not made. Now in that case, can section 73 and 74 be invoked on Mr. Amar? So for that they gave a clarification. So section 73, 74 comes into picture only when there is supply and GST liability. So when there is no supply, just because giving invoice by Amar to Balaji, there is no liability on Amar. So due to that reason, we cannot initiate 73, 74 on Mr. Amar. However, we have section 122 subsection 1 penalty that can be levied on Amar. What is that? Invoice default. Giving invoice without making supply is one of the reason for penalty, is one of the offense for penalty under 122 subsection 1. That penalty, that is 100% of the tax involved or 10,000, whichever is higher. So in this invoice, what is the tax involved? That or 10,000, whichever is higher, under each act can be levied on Mr. Amar, not on Mr. Balaji under 122 subsection 1, and 73, 74 is not applicable to Mr. Amar. So that is the first issue for which they have given the clarification. Continuing to the same example, now Amar has given invoice to Balaji without making supply. Now we have seen what are the penal consequences, demand and recovery on Amar. Now let's come to Balaji's case. Balaji has taken in ITC based on this invoice without actual receipt of goods or services. Can section 73, 74 be invoked on Mr. Balaji? Yes. So section 73, 74, suppose here it is 74 only, not 73. Why? 73 will come other than fraud, but 74 is on account of fraud. So this is on account of fraud. There is a guilty mind, there is an intention to evade present. So section 74 can be invoked on Mr. Balaji. They can give a notice under 74 and collect that ITC wrongly availed along with interest and penalty. Also here, can there be a penalty imposed under section 122 also on Mr. Balaji, for which, so that is already 73, 74 is invoked on Mr. Balaji. So 122, because in 122 ITC default is also an offense. Can that penalty also be levied on Mr. Balaji, for which they gave a clarification that if penal action for fraudulent availment of ITC is taken against Balaji, okay, under 74, no penalty for the same act, can be imposed on Balaji under any other provision. So section 122 is not applicable for Balaji. Now, this can be tested in exam as a question that, so what are the penal consequences on the supplier and recipient? What we need to write on supplier? So penalty is imposed under section 122 subsection 1 on account of invoice default, whereas on Mr. Balaji, so he has availed the ITC. Suppose if 74 notice is issued to Balaji for recovering the ITC availed along with interest and penalty, then 122 subsection 1 penalty will not come. If 74 notice is not given on Mr. Balaji, then on Mr. Balaji there can be 122 subsection 1 penalty. So that is the clarification with respect to the second issue. Now the third issue, that is Amar has raised invoice on Balaji without actual supply of goods. Balaji availed the ITC and Balaji raised invoices to another person, Mr. Charan, and this also invoice raised but supply is not made. So Amar, Balaji and Charan. Amar raised invoices to Balaji. Balaji raised invoice to Charan. No supply of goods by Amar to Balaji or Balaji to Charan. Now in this case, what will happen? First, on Amar, there is no possibility of recovery under 73 or 74. However, penalty can be levied under 122 subsection 1 invoice default on Amar. Now when it comes to Balaji, Balaji has done two offences. Offence number 1, he availed the ITC without actual receipt of goods and he gave an invoice without supply of goods. Now in this case, again recovery cannot be made on Mr. Balaji under 73-74. However, penalty can be levied because there is no supply, there is no outward supply. So that's the reason why on Mr. Balaji, recovery cannot be made because he availed ITC and he utilized also. So we cannot recover from Balaji. He availed ITC and he showed that as a liability also. So therefore, recovery cannot be made in terms of 73-74 from Mr. Balaji. So what does the circular say is, on Balaji also there can be penalty under 122. But now under two clauses penalty can be levied on Balaji. What are the two clauses? First, the penalty could be on account of invoice default because he is making supply without, like he is giving invoice without supply, invoice default. And another offence is availed ITC default without actual receipt of goods, ITC default. So there can be two penalties on Mr. Balaji. Atrocious. This is really atrocious. So there will be two penalties because the words used in the circular is and. The words used in the circular is and. So there will be two penalties on Balaji. So what are the two penalties? One is invoice default, another is ITC default. Then again, Balaji is raising invoice to Charan and Charan would have taken ITC. We don't know whether he subsequently utilized or not. So to recover that ITC, 73 or 74, usually 74 notice and recovery can be on Mr. Charan and the penalty will be under 74. But 122 subsection 1 will not be applicable to Charan. Let's proceed to amendments in the next segment, that is refund under GST. In these refunds under GST, there are innumerable amendments, lot of amendments are there. And in that, the first area which we are going to see is amendments in section 54, section 54 itself, which talks about refund of taxes. So in that section itself, let's see what are all the amendments. The first amendment is claiming refund through return is now omitted. So previously, we will be able to claim the refund, that is excess balance in the ledger, cash ledger, we can claim it as a refund in the return itself. But now, that point has been omitted because practically they did not allow claiming refund through 3B or any other return. That's the reason why whenever there is an excess balance in the cash ledger, for that we need to separately file a refund application, that is in RFD 1, and we need to claim the refund in a normal manner. So therefore, requirement of claiming such refund through return has been removed. That is the first amendment. The second amendment is time limit for refund in case of UIN holder. As per section 54, previously we had a time limit for availment for getting the refund, time limit. Usually the time limit to make a refund application was 2 years from the relevant date, and even now also it is 2 years from the relevant date for all cases. But in case of UIN holder, so the time limit was 18 months, 18 months from the last date of the quarter in which supply was received. So unique identification number holder will be claiming refund. So that refund when they are claiming, so what is the time limit to make the refund application? 18 months from the end of the quarter in which supply is received. But now what they are telling, to streamline the time limits as equally 2 years, so they are telling, so the 2 years from the last date of the quarter in which the said supply was received as against the 6 months, that 6 months got extended to 18 months. But now that is also they are omitting and they are making it as 2 years. So UIN holder will be making some purchases on which they pay GST. That GST they can get it as a refund. So whichever quarter they made purchase, for example, they made purchases for the quarter July to September. Now within 2 years from the end of September quarter, they should make the refund application. So that is the second amendment. The third amendment in section 54 is withholding of refund. So previously, the withholding of refund was applicable only in case of refund on account of unutilized ITC. So that is whenever the refund application is made by the registered person and when there is an outstanding demand order against that person, that is he need to pay some taxes due to the government. So then whatever refund that will be sanctioned to them, that will be withheld. So this was previously given for refund of unutilized ITC. Now any refund, so the department is having power to withheld. So that is now extended for all cases. Then the fourth amendment in section 54 is relevant date in case of refund claim by SEZ, because it was not clearly mentioned. So that's why they are telling, because usually the refund application should be made within 2 years from the relevant date. So what is the relevant date? In case of exports, in case of supply to SEZ not given, in case of exports it is given, in case of refund of unutilized ITC on account of inverted tax structure, in case of refund on account of decree order, like that, everywhere it is given. But when it comes to refund on account of supply to SEZ, they have not given the relevant date. Now it has been given as the due date of filing GSTR 9. Due date of furnishing GSTR 9 in respect of such supplies should be taken. Now, let's proceed to the next amendment in refunds, that is, previously there was one refund to retail outlets in the international airport. So that is, whenever there is a retail outlet in international airport, they are making purchases, and when they are making supply to a tourist, that supply was exempted, and whatever GST they paid on purchases, they can get as a refund. Now that is completely omitted. So we don't have the concept of refund to retail outlets. So that refund is completely omitted now because of this notification. Then yet another amendment in refund, that is refund rule 89. Rule 89 talks about refund in case of unutilized ITC. So in this rule 89, there are some amendments. The first one is refund of balance in the cash ledger cannot be claimed to returns, which was already provided in section 54. Consequential amendment they made in rule 89 also. Section 54 previously said that excess balance from the cash ledger, you can claim it as a refund through return, but now it is not possible. That's why they made this amendment here also. Then what they need to make a separate application for refund. Then whenever supplies are made to SEZ, so there is a documentary evidence that is required. The SEZ officer should endorse that these supplies what we are making to SEZ is used for the authorized operations of SEZ. But now that endorsement need not be done by SEZ officer, it can be even endorsed by an authorized officer of SEZ. So previously it was by specified officer of SEZ. Now even an authorized officer of SEZ can also do the endorsement. Then the third amendment in rule 89 is in case of refund on account of export of electricity. Whenever there is an export of electricity, refund of ITC can be claimed. For that, they are giving that whenever we are making an application for refund, that should be accompanied by a statement containing the number and date of the export invoices, details of energy exported, tariff per unit for export of electricity as per the agreement, along with copy of the statement of scheduled energy for export of electricity by generation plants issued by the authorities, respective authorities, and a copy of agreement detailing the tariff per unit. These are all the supporting documents that should be given along with the application in case of export of electricity. Then next one, what is the meaning of value of exports declared? Because while claiming refund of unutilized ITC, the formula is net ITC into zero rated turnover divided by adjusted total turnover. In that zero rated turnover, in case of zero rated supply of goods, exports, we will take value of exports declared or 1.5 times of the similar goods sold by similar supplier in the domestic market, whichever is lower. Now, what will be taken as the FOB value declared? FOB value declared where? Is it in the invoice or is it in the shipping bills for the purpose of customs? So, take FOB value declared in the shipping bill or bill of export from the customs, that should be taken, and that or value of declared in value in the invoice, whichever is less. So, now what is the value of exports that should be taken in the refund formula? So, it is value of exports equals to value declared or 1.5 times of the similar value in the domestic market, whichever is less. Okay, these two, whichever is less. What is the meaning of value declared? Value declared in the FOB value declared in the shipping bill or bill of export for customs, or value declared in the invoice, whichever is less. So that should be taken. So again I am repeating, we need to take value of goods for the purpose of export, value declared, or 1.5 times the similar value in the domestic market, these two, whichever is earlier, whichever is lower. Again, what is the meaning of value of declared value? FOB value in the shipping bill or bill of export for customs, or value declared in the invoice, export value declared in the invoice, whichever is less, that should be taken. The next amendment in Rule 89 is with respect to change in the formula for refund of unutilized ITC on account of inverted tax structure. So now let's see what was the formula before amendment. Before amendment, the formula was the formula was net ITC into inverted turnover divided by adjusted total turnover, minus GST on inverted turnover. This was the formula before amendment. Now they have omitted this formula completely and they created a new formula. What is that? So the refund, maximum refund on account of inverted tax structure. What is inverted tax structure? The tax rate on outward supply is less than the tax rate on inward supply. The formula will be net ITC into inverted turnover by adjusted total turnover. That first part is same, minus net ITC into GST on inverted turnover divided by total ITC on inputs and input services. Here we need to remember one important point. When we take net ITC, the net ITC is only with respect to inputs. The net ITC is only with respect to inputs, not with respect to input services. But there are two parts in the formula. The first part is net ITC into inverted turnover by adjusted total turnover. So now in the logic you can easily understand, out of the total ITC, how much pertains to inverted turnover, that is one part. Minus, out of that ITC, how much is used for payment of taxes. So net ITC into taxes payable on inverted turnover divided by total ITC on inputs and input services. Now whatever balance we get, that will be the refund. So compared to the previous formula, now in this formula actually we are going to get more refund only. So it is not less refund, it is going to get more refund only. And let's try to understand this amendment with the help of some illustrations. So I am taking these illustrations from solved workbook. So you can look into this question number 3 in page number 367 in solved workbook. From the following information, you are required to determine the maximum amount of refund admissible on account of inverted tax structure. Input tax credit availed on inputs 3,60,000. On inputs 3,60,000 is the ITC. And on input services 36,000. And turnover of inverted rate supply of goods is 30 lakhs. This is inverted turnover. And turnover of other supply of goods is 10 lakhs. Now, what is the formula here? First, we need to arrive at 5 points. What are the 5 points? First, you need to get net ITC. Second, you need to get inverted turnover. Third, you need to get adjusted total turnover. And fourth, you need to get tax payable on inverted turnover. And fifth point, what you need to get? Total ITC on inputs and input services. So 5 points you need to get. Point number 1, net ITC. What is net ITC? Only ITC with respect to inputs. What is ITC with respect to inputs? ITC with respect to inputs is 3,60,000. That is the first one. Second, inverted turnover. What is the inverted turnover here? 30 lakhs. Then third, total, adjusted total turnover. Adjusted total turnover will be total, inverted plus non-inverted, 36 plus 10, 40 lakhs. Then we need to take tax payable on inverted turnover. Inverted turnover 30 lakhs into 5%. So that is 1,50,000. Then last, fifth point, that is total ITC on inputs and input service. Total ITC on input service, inputs and input service 3,60,000 plus 36,000, that is 3,96,000. So now these 5 points. Now what is the formula? Net ITC into 1 into 2 by 3. 1 into 2 by 3. Net ITC into inverted turnover by total turnover. That is 3,60,000 into 30 by 40. 3,60,000 into 30 by 40. That is 1 minus net ITC 1 into, so 4 by 5. What is 4 by 5? That is tax payable divided by ITC on inputs and input service. So 3,60,000 into 1,50,000 divided by 3,96,000. So the difference comes to 1,33,636. So 1 into 2 by 3 minus 1 into 4 by 5. So what is 1, 2, 3, 4, 5? 1 is net ITC, 2 is inverted turnover, 3 is adjusted total turnover, 4 is tax payable on inverted turnover, 5 is total ITC on inputs and input services availed. Now let's see one more question. This is question number 5, page number 396. This was an RTP question, and that I am modifying as per the current amendment. First, Super Engineering Works, a registered supplier in Haryana, is engaged in supply of taxable goods within the state. Given below are the details of the turnover and applicable GST rates of the final products manufactured by Super Engineering Works, as also the ITC availed on inputs used in manufacture of each of the final products and GST rate applicable for the same period. So the Super Engineering Works is making 3 products A, B, C, and the turnover is given and the GST rates are given. If you see product A, the GST rate on outward supply is 5 as well as on the input is 18%, that's an inverted turnover. Because inverted turnover means the GST rate on outward supply is less than the GST rate on inward supply, so that's an inverted turnover. Then B, if you see, so B is 5%, 18%, so B is also inverted turnover. And C 18%, 18%, so C is not an inverted turnover. A and B is inverted turnover. Now determine the maximum amount of refund of unutilized ITC that Super Engineering Works is eligible to claim under section 54, provided product B is notified. So in refund of unutilized ITC on account of inverted turnover, if a product has been notified for non-applicability of refund, then on that we cannot claim ITC refund even though it's an inverted turnover. So in this example, product B is inverted turnover, but it is notified that refund will not be available with respect to this. So which means that we will not be able to get the refund on this product B even though it is inverted turnover. Then the refund is possible only with respect to product A. Now what we need to do is that, what generally we think is that we will take for product A only, we will ignore product B and C. So for product A, what is the ITC? 54,000, that is net ITC into inverted turnover 5 lakhs divided by total turnover, will take 5 plus 3, 8 plus 1, 9, 9 lakh 50, but that's wrong. Because even though one input is inverted, but when we take the net ITC, we should take total ITC of all the inputs that is given in the circular. So we have a circular which says that, so that is even though one of the invert supply, so you can see that here, even though one of the invert supply is inverted, but the net ITC is with respect to all. So then we will be taking in net ITC input credit availed on all inputs during the relevant period. So what is that? We will take an ITC availed net ITC, that is 1, 2, 3, 4, 5. 5 we need to get. Number 1, net ITC. What we will take in net ITC? 54,000 plus 54,000 plus 10,000. 54 plus 54 plus 10, that is first. That will be 1,18,000. Okay. Irrespective of whether ITC pertains to inputs eligible for refund or not. So as per this circular number 7953/2018, we should take total. So we have taken. Number 2, inverted turnover. What is inverted turnover in this? Only A, that is 5 lakhs. So 5 lakhs will be taken. Then adjusted total turnover. Adjusted total turnover means total 5 lakh plus 3 lakh 50 plus 1 lakh. So that comes to 9,50,000 adjusted total turnover. Then fourth one will be tax payable on inverted turnover. Tax payable on inverted turnover, if you see 5 lakhs into 5%. So 5 lakhs into 5%, that will be so 25,000. And next last one, total ITC on inputs and input services. So it is same as 1 because we don't have input services, everything is input. So this total only will come. So 54 plus 10, 1,18,000 only. Now the formula will be 1 into 2 by 3. So that is net ITC 1,18,000 into inverted turnover by adjusted total turnover 1,18,000 into 5 by 9.5 minus net ITC into tax payable on inverted turnover divided by ITC. So 1,18,000 into 25 by 1,18,000. So only 25,000 will come. So therefore the balance will be 37,105 is the refund what we get. So compared to the previous illustration, in this illustration what we have learnt is that when we have multiple inputs and these multiple inputs, even though one only is inverted turnover, but we will take net ITC. So total ITC with respect to all the 3 inputs. Now next question is question number 8 in page number 371. So this is RTP May 19 question. So as there is a change in the formula with respect to refund of ITC on account of inverted rate structure, so I have answered this as per the amended provision. Kailash Global Private Limited supplies various goods in domestic and international market. It is engaged in both manufacturing and trading of goods. The company is registered under GST in the state of Karnataka. The company exports goods without payment of tax under LUT. So which means there are 2 options available. So they are going for option 1, export upon payment of IGST, or option 2, export without payment of IGST. Export without payment of IGST under LUT, which means that they get the refund of unutilized ITC. So the company has made the following supplies during a tax period. Number 1, export of product A to UK for $10,000. Assessable value under customs in Indian rupees. Export duty is levied on product A at the time of export. So we have a restriction. Generally, refund of unutilized ITC is available in case of exports if the export is without payment of tax under LUT or bond. However, the refund of unutilized ITC is not applicable if such exports are subject to export duty or duty drawback has been claimed. So in this case, as these exports are subject to export duty, we will not be getting the refund of unutilized ITC. Okay, sir, then can we pay GST and get it as a refund? That is also not possible because they are going for which option? Payment of tax under without payment of tax under LUT, which means that in this case they will not pay any tax. They will not pay any tax on 7 lakhs, and even this will not be eligible for refund. So no refund in this case. No refund in this case. Why no refund in this case? Because there is a restriction that refund of unutilized ITC is not applicable if exports are subject to export duty. So therefore this 7 lakhs will be treated like without GST, but it will be taken into the turnover. Then next one is domestic supply of taxable product B during the period excluding tax at 5%. Inputs used in manufacturing of such goods are taxable at 18%. So it's a inverted, because outward is taxable at 5% and inward is taxable at 18%. When the GST rate on outward supply is less than the GST rate on inward supply, that is known as inverted tax structure. So this is an inverted tax structure. In case of this inverted tax structure, are we eligible to get the refund? Yes, if this product is not notified. Is it notified? No, it is not notified. If it is notified, we will not get refund. If it is not notified, yes, we will get refund in this case, refund of ITC. Then number 3, supply of goods to EOU. Supply of goods to EOU is deemed exports. Whenever we are making supply to EOU, that's a deemed export. In case of deemed exports, there are 2 options. Either the supplier can collect the GST from the recipient and treat it as a normal sale, wherein recipient will get the refund, or supplier will not recover the GST from the recipient, and whatever GST they pay, they can get it as a refund. There are 2 options. But in this case, so they are going to, so ITC has been claimed by recipient. What does it mean? The supplier has charged GST to the recipient. The supplier has charged GST to the recipient. So therefore, recipient has taken the ITC, which means that in this case, supplier will not get refund, recipient is going to get the refund. So for supplier, there is no refund in this case. So this will be treated like a normal sale for the supplier. Then number 4, export of exempted supply of goods. See, generally the goods are exempted, but the moment it is exported, it will become zero rated. This point has already been tested in November 22 exam. So, generally exempted goods or services, the moment it is exported, it will become zero rated, and they are going for zero rated without payment of GST under LUT option, which means that they can claim refund of ITC in this case. They can claim refund of unutilized ITC in this case. Then the ITC available for the above tax period is as follows: on inputs including 50,000 on export of exempted supplies, on capital goods 1,20,000, on input service including 18,000 on outdoor catering. Determine the maximum amount of refund available to Kailash Global Private Limited for the given tax period. We will see first the refund on account of zero rated supplies. The refund on account of zero rated supplies. What is the formula for refund on account of zero rated supplies? Net ITC into zero rated turnover divided by adjusted total turnover. So, what is the net ITC? In case of exports, we will take in ITC, net ITC, not only inputs but also input services. So, in net ITC, we should take 3,50,000 plus 2 lakhs minus 18,000. Net ITC availed, only matched ITC. Net ITC availed is only matched ITC, that is there in 2B. And in that, I told you already that we should take out blocked credits, ineligible ITC. So, therefore, 2 lakh minus 18,000, 1 lakh 82,000 will be taken. So, 3 lakh 50 plus 1 lakh 82,000, that will be the net ITC here. So, you can see net ITC will be, so 3 lakh 50. So, 3 lakh 50, one second, net ITC with respect to net ITC 5 lakh 32. Why 5 lakh 32,000? ITC on outdoor catering is disallowed. So, therefore, 5 lakh 32 should be taken. 3 lakh 50 plus 1 lakh 82,000, 5 lakh 32,000 into zero rated turnover of goods, that is export of goods. What is the value of export of goods? If you see export of goods value is 6 lakhs, but we will take 6 lakhs or FOB value declared or 1.5 times similar. What is 1.5 times similar? 5 lakhs into 1.5, 7 lakh 50, whichever is lower. So, 6 lakhs only will be taken. Won't we take this 7 lakhs? No, 7 lakhs should not be taken. Why? Because on that we are not claiming refund. Only those exports on which we claim refund should come in numerator. So, therefore, 6 lakhs. And in denominator, adjusted total turnover. What is adjusted total turnover? Export turnover, domestic turnover, everything, but excluding exempted turnover. So, here we don't have exempted turnover. So, we will take 7 lakhs, 10 lakhs, 5 lakhs, 6 lakhs, 28 lakhs total. So, the formula will be, so total net ITC into net ITC 5 lakh 32,000 into zero rated turnover 6 lakhs divided by 28 lakhs. So, 1 lakh 14,000 will be taken as the maximum refund. So, this is the answer for this. 1 lakh 14,000 will be taken as the maximum refund in case of zero rated turnover. Now, we will see inverted rate turnover. For inverted rate turnover, we need to get 5 information. Number 1, that is second refund we are claiming. So, number 1, net ITC. Net ITC now only restricted to inputs. What is the net ITC? 3 lakh 50. Now restricted only to inputs. Second, inverted turnover. What is the inverted turnover? 10 lakhs. Adjusted turnover same, 28 lakhs. So, the meaning of adjusted turnover for normal refund on account of zero rated supplies as well as refund on account of inverted trade structure, both are same, that is 28 lakhs will be taken. Then third, over. Fourth, what is the GST payable on inverted turnover? 10 lakhs into 5%. So, that 50,000 will be taken as GST payable on inverted turnover divided by total ITC availed on inputs and input services. What is that? 3 lakh 50 plus 1 lakh 82,000, 5 lakh 32,000. These are the 5 numbers. So, first we need to take 3 lakh 50 into inverted turnover by adjusted total turnover, 3 lakh 50 into 10 by 28 normal, minus 3 lakh 50 into tax payable on inverted turnover 50,000 divided by, so total ITC on inputs and input service 5 lakh 32. So, we will get 92,105. So, as per last like previous formula, we used to get 75,000 only. Now, we will be getting 92,105. So, we will get more refund only as per this formula. So, therefore, what is the total refund in this case? Here it is 1 lakh 14 and here it is 92,105. So, that is the total refund we can claim in this case. Now, Already we computed in net ITC for zero rated turnover 3,50,000. Should we take it again? Yes, we should take it again because the formula we need to follow. But ultimately, not that we are going to get this entire amount as refund. The refund is subject to balance. How much ever balance that is there in ITC, that much only we are going to get as a refund. Then next question is question number 10 in page number 374. It is a December 21 question. For 5 marks they have given. J & Company, a registered supplier under GST, engaged in weaving yarn into fabrics, has provided the following information. Nature of various intrastate supplies during April 2021, value of supply excluding GST, outward supply of fabrics, tax rate of CGST, SGST 2.5% each. Then inward supply of rayon yarn, tax rate is CGST, SGST 6% each. It's an inverted turnover because outward supply is taxable at 5% and inward supply is taxable at 12%. So it's an inverted. Inward supply of services for processing the yarn is 4 lakhs. Inward supply of machineries, capital goods for processing the yarn into fabrics is 45 lakhs. Now, the above concern has not provided any other supply other than the outward supply referred above, means 100% is inverted turnover only. So now, ITC in respect of all the inward supplies are given was claimed in 3B, which was reflected in 2B, means these are all matched ITC only. Other applicable conditions are duly complied with, which means it is not a notified product. So can we take ITC refund in this case? Yes. So what is the 5 informations that we need to get? First, net ITC. What is the net ITC? Only on inputs. So 24 lakhs into 12%. So that is the first point. 24 lakhs into 12%, net ITC 2,88,000. Second, inverted rate turnover. Inverted rate turnover is only outward supply, fully that only 30 lakhs, and adjusted total turnover also 30 lakhs. Tax payable on inverted turnover. Tax payable on inverted turnover will be 30 lakhs into 5%. So that is 1,50,000. And total ITC on inputs and input services. Don't take capital goods. Inputs and input services. That is, so 24 lakhs into 12% plus 4 lakhs into 5%. So that will be 3,08,000. Now the formula. So these are the 5 numbers we need to get. Net ITC, inverted turnover, adjusted total turnover, GST on inverted turnover, and total ITC on inputs and input service. So 2,88,000 into 30 by 30, 2,88,000 minus 2,88,000 into 1,50,000 divided by 3,08,000. So we will be getting 1,47,740 as the refund. What is speciality in this question compared to the previous question? In this question, so fully we have inverted rate turnover only. And the previous question is mixture of everything, zero rated as well as inverted, how we need to do. And even before that question is like multiple inputs and output. So what we need to do. And this is a basic question. So these are the 5 types of questions that can be tested on inverted rate turnover. Any one question you can expect for the forthcoming exams, because as the formula has completely been amended, so any question can be asked in the May 23 exam in respect to this. So far I have given you 2 guaranteed questions on amendments that will be possible. One on interest computation section 50 subsection 3. Another is this refund of unutilized ITC on account of inverted rate turnover. Now we are looking into the next amendment. This amendment is in Rule 96. So Rule 96 is talking about refund on account of zero rated supplies upon payment of IGST. How this works? So whenever I have some inputs and input services and capital goods, I can use that ITC for payment of IGST on zero rated supplies. Now whatever is the gross IGST that I have paid, that I can get it as a refund. So that is what Rule 96 says. In that Rule 96, there are few amendments. The first amendment is, in Rule 96, the reference to GSTR 3 has been omitted. Because previously GSTR 3 was given, but now there is no GSTR 3. This is only GSTR 3B. That's why the reference of GSTR 3 has been omitted. What is the purpose of this GSTR 3 related to the refund? Whenever we make shipping bill, so the shipping bill itself is the application for refund in case of export upon payment of IGST. The customs officer will cross check whether IGST has been paid by reference to our GSTR 3B. That's the reason why in GSTR 3B, whenever we make export upon payment of IGST, that has to be separately shown in GSTR 3B table 3. So, customs officer will cross check. So, previously it was given as GSTR 3, but now it has been amended to GSTR 3B. The second one is date of rectification after mismatch is the date of application. What is this all about? So, let's see this with the help of a situation. First, so we have made an application for the purpose of refund. When we made the application for refund, so that application is nothing but the shipping bill. So, shipping bill filed with the customs officer is the application for refund. And that has been cross verified by the customs officer in our GSTR 3B whether IGST has been paid. So, we made a mistake. The mistake is that in GSTR 3B, in table 3.1, this has to be shown separately that we are exporting upon payment of IGST. Like this, in GSTR 3B, in table 3, so 3B if you see, outward taxable supply 0 rated. So, we have to mention what is the taxable value and what is the IGST that has been paid. So, whatever IGST that we mention in the shipping bill will be cross verified with this IGST as per GSTR 3B. The common mistake what many people will do is that, so they will mention this outward taxable supply 0 rated upon payment of IGST, instead of mentioning it in table 3.1b, they will be mentioning it in table 3.1a itself. Regular taxable supplies they will mention, because of which there will be mismatch between whatever shipping bill that we file versus this GSTR 3B. Now, when this mismatch happens, so we need to give a clarification, and thereafter after rectifying, so after rectifying this GSTR 3B, because now GSTR 3B can be rectified. Previously it was not possible, now it can be rectified. We have that. So, upon rectification of the GSTR 3B, so the refund will be processed. So, what will be taken as the date of application? Is it the date on which we have given this shipping bill, or is it the date of rectification of 3B? Because once we make an application, within 60 days, if the refund is not granted, interest will be payable. So, due to that reason only, now they have given an amendment in Rule 96. What does that amendment says? So, a proviso has been added in Sub-Rule 1 specifying that if there is any mismatch between the data furnished by the exporter in shipping bill and those furnished in the statement of outward supplies, such application for refund of integrated tax shall be deemed to have been filed on such date when the mismatch in respect of the shipping bill is rectified by the exporter. So, here the reference is given as GSTR 1, but GSTR 3B is also the problem here. So, either GSTR 1 or in GSTR 3B. So, the date on which the rectification happens, that will be taken as the date of submission of application. The next amendment is with respect to Aadhaar authentication in Rule 96. Now, they have added that at the time when we make refund application, so the Aadhaar authentication is required, because whenever GST practitioners are making application for refund, so they were making some fake claims. So, due to that reason, in order to avoid that, now they are doing Aadhaar authentication so that it will be communicated to the person, registered person. So, he will verify, and yes, if it is proper, then he will share the OTP with the GST practitioner. So, upon filing that OTP, other OTP, then only the refund application is said to be made. Yet another amendment in Rule 96 is withholding of refund. There is one more reason added for withholding of refund. Whenever the application for refund is made, that is the shipping bill has been filed, and customs officer wanted to verify the credentials of the exporter, including the ITC, utilization, availment, etc. So, due to that reason, the customs officer can, or the GST officer can withhold the refund that is to be processed. That is with respect to this, where the claim of refund shall be withheld where the commissioner in the board or an officer authorized by the board. They use the word board, so which means they are bringing even customs officer into the picture. On the basis of data analysis and risk parameters, is of the opinion that verification of credentials of the exporter is required before releasing the refund or including the availment of ITC, so that refund can be withheld in the interest of the revenue. And two new sub-rules have been added in Rule 96, Sub-Rule 5A and Sub-Rule 5B. This Sub-Rule 5A and 5B is connected to, so this withheld of refund only. Say, officer has withheld the refund. For what reason? In order to verify the credentials. And after verification of the credentials, so that information will be updated. So after updating that information only, so the refund will be processed. So for that purpose, they created this procedure where the refund is withheld. Why refund is withheld? For the purpose of, verifying the credentials of the exporter. And so they will be, the customs officer who processes the refund will be withholding the refund and will be requesting the proper officer under GST to verify the credentials. Now the proper officer passes the order for withholding refund due to violation of customs. Such claim shall be transmitted to the proper officer, okay, as the case may be electronically through the common portal in form RFD1, and the intimation of such transmission shall also be sent to the exporter electronically through the common portal. So now, the date when this intimation is given by the proper officer back to the customs, that date only will be taken as the date of application. The said system generated form shall be deemed to be the application for refund. And there are few rules which were previously related to this withholding of refund has been omitted. That is form RFD 7, part A, part B, RFD 6 related to this withholding of refund. That entire concept has been omitted because now that has been incorporated in Rule 5A and 5B. The last area of amendment in refund of tax is few circulars that has been provided. So in that, the first circular issue we are going to discuss, that is, whenever deemed export happens, how things work, let's try to understand. There is a supplier who is making supply of goods to an exporter. For the supplier, it will be treated as deemed export. So, supplier who is making supply to the exporter, so that supply is known as deemed export. Now, there are two options available to this supplier. This supplier may recover GST from the recipient, and this supplier will treat it like a normal sale, and whatever GST that is paid by the recipient, that is exporter, he can claim it as refund, he can get it as a refund. And to get it as a refund, what he need to do is that, first he need to take it as ITC, and then he will be claiming it as refund. So the moment when he claim it as refund, so the ITC avail in the credit ledger gets debited. So exporter first will take the ITC, and after taking the ITC, so exporter will claim the refund because he is the recipient. When he claim refund, that amount will be debited to the electronic credit ledger and he will get that as refund. Another option is that the supplier may not recover GST from the recipient. Supplier will not recover any GST from the recipient, just the supply will be made and price alone is collected. Now the supplier will pay GST to the government and the supplier will get it as a refund. Now, let's see the first option. So now exporter is taking ITC because exporter makes payment of GST and exporter takes it as ITC, and exporter will get the refund of that ITC availed. Now, the issue here is that whenever these inward supplies are blocked credits under section 17, subsection 5. So there are some inward supplies received by this exporter and that is blocked credits. And can that also be taken as ITC and can he get it as refund? Generally, blocked credits cannot be taken as ITC. But this is one favorable circular which says that whenever this supplier is making supply to the exporter, even though it is blocked credit to the exporter, as it is deemed export refund, he can avail it as ITC, and he can claim the refund. But this facility is given only in case of deemed export, not in any other case. So that is this first issue about. Now the second issue in the circular is that generally in case of zero rated supplies, the refund that will be claimed will be net ITC into zero rated turnover divided by adjusted total turnover. Now, whenever in case of deemed exports, supplier is making supply to an exporter. Now, the exporter will claim the refund of unutilized ITC because of export. Now, when he claims the refund of unutilized ITC on account of export, not on account of purchase, on account of export, he will claim the refund of unutilized ITC, not refund of ITC on account of deemed export, what he gets. Now, the question here is that he is having two ITCs. One ITC is with respect to purchases from a supplier which will be treated as deemed export supply to him, on which he will take ITC as refund. Second, upon export, this exporter will get the refund of unutilized ITC. Now, when you take net ITC in the formula, whether both the ITCs needs to be taken, for which the clarification given is that already on purchases which were deemed exports, ITC availed got as a refund. Already they got as a refund. That ITC should not be taken into net ITC into zero rated turnover by adjusted total turnover. This is what usually I tell in the class. That is, if you take Spider-Man, the red color Spider-Man is the ITC with respect to exports. ITC on inward supplies on which GST is paid, and that is used for exports. Now, this red color Spider-Man has got the Venom, black, okay, Venom. And that Venom is what? ITC with respect to inward supplies, which were considered as deemed exports. Now, already on that they are getting the refund, so that has to be taken out. That Venom has to be taken out. So, therefore, the remaining ITC is the net ITC. So, total ITC minus ITC with respect to inward supplies on which refund already claimed under deemed export, the remaining net ITC into zero rated turnover divided by adjusted total turnover should be considered. Now, you may ask, sir, why are you comparing this ITC with respect to deemed export to Venom? Even though Venom is a hero, but it is in a different universe, parallel universe. So, not in Spider-Man's universe. So, therefore, already refund has been claimed with respect to that, already you enjoyed the benefit over. So, now in this universe of zero rated supply, so this Venom is not a hero anymore. So, we will be taking him out. So, that's the reason why I just compared it to that logic to remember. Now, there is a third issue. The third issue is with respect to inverted tax structure. In inverted tax structure, what will happen is that we will be getting refund on account of inverted tax structure if tax rate on outward supply is less than the tax rate on inward supply. One circular has been provided that if inputs and outputs are in the same category, input-output is in the same category, but has a different rate of GST, and the rate of GST on input is less and the rate of GST on output is, the rate of GST on input is high and the rate of GST on output is less, but both are in the same category. So, if you take some goods which are packed and sold, so on inward there may be a lesser rate, and when it is packed and sold in retail packs, maybe it will be having a higher rate. Now, in that case, even though purchases and sales is same goods, but purchases are at a higher rate and packed items which are sold may be at a lower rate, then it will be an inverted tax structure. Then one circular says that you will not get the refund, that is circular number 135/5/2020. So, refund of accumulated ITC would not be applicable in case where the input and output are in the same, that is refund of unutilized ITC not admissible on account of inverted tax structure where the inversion is due to change in GST rate on the same goods. There could be another reason also. Before one date, so we made a purchases at a higher rate. After the date onwards, the rate has been reduced on that goods, we will not get. Now, they have given another circular substituting the previous circular. What they are telling, if there is a decrease in rate, we purchase some goods and we are selling those goods. The decrease in rate is on account of any concession provided under the law. For example, we are purchasing cloth which will be taxable at say 12%. We are selling the garments which will be taxable at 18% normal. Now, we purchased the cloth which is taxable at 12%. We made uniforms for defense uniforms, and those defense uniforms will be taxable at a concessional rate, say 5%. Now, in that case, so because of the concessional rate, we are getting inverted structure. Whether we will get the refund? Yes. Suppose if we are purchasing and selling uniform, same goods. If we are purchasing and selling uniform, same goods, we purchased normally at the time normal rate, but when we sell these uniforms or cloth to defense, that may be at a lower rate because of the concession. Then in that case also we will get the refund of unutilized ITC. Yes, that's what they are telling. Therefore, in the cases where though inputs and output are same, but the output supplies are made under a concessional notification due to which the rate of tax on output supplies is less than the rate of tax on inputs. In such case, as the rate of tax is less than the rate of tax on inputs at the same point of time, due to supply of goods by the supplier under such concession, the credit is admissible. Okay, refund of accumulated ITC is admissible. Unless otherwise the concessional rate is nil rated or exempted, or it has been notified by the government for non-applicability of refund. With this, we completed all the amendments in GST. So, there is no amendments in miscellaneous provisions. So, these are the various amendments that is applicable with respect to GST. Now, we are moving on to amendments in customs and FTP. With respect to amendments in customs and FTP, we don't have much amendments in customs except for valuation, then procedures. Then with respect to FTP also we have only 2 amendments. So, that many amendments we don't have in customs and FTP. Now, we have an amendment in valuation, that is with respect to section 14 of Customs Act 1962, which says that the purpose of valuation rules under customs is now extended. So, whenever an importer or exporter is unable to determine the transaction value in terms of section 14, then reference will be made to valuation rules. So, those valuation rules will be applicable when buyer and seller are not related. So, generally an importer or exporter will go for transaction value, which will be price prevailing at the time and place of importation in case of import, price prevailing at the time and place of exportation in case of export. So, on import we take CIF price, on export we take FOB price. This is the usual transaction value. But when this transaction value not applicable, and we will make reference to the rules. Situation number 1, that importer and exporter are related, or number 2, that is, so price is not the sole consideration. When the price which is paid by the importer to the exporter or exporter to the importer is not the sole consideration, or the proper officer is having doubts about the truth and accuracy of such value. This is the third situation. Then also reference will be made. So, value will be value whatever is declared by the importer or exporter will be rejected, and proper officer will determine the value when the proper officer under customs is of the view that, so the truth and accuracy with respect to the declared value, he has doubts with respect to that. Now, the fourth situation is that, so that is whenever proper officer, is of the opinion that there are additional obligations on the importer with respect to the imported goods, including the circumstances and manner of exercising those obligations. So, wherein proper officer has reason to believe that such goods may not be declared truthfully or accurately, having regard to the trend of the declared value of such goods. It's like exporter has put some obligations on the importer that in order to fulfill that obligations, so the value declared will not be correct, because this fulfillment of obligations by the importer may also be a consideration that he will be giving to the exporter if he is of the opinion. That is, there are some obligations on the importer to fulfill, which is kept by the exporter. So then officer is of the opinion that the declared value may not be correct. Then also the reference will be made to the valuation rules. Now we are moving on to amendments in customs, procedures under customs, the next segment. And in the remaining segments like types of customs duty, taxable event, etc., we don't have any amendments. In this, procedures under customs, the first amendment is with respect to Section 3 of Customs Act has been substituted by Finance Act 2022, determining who are the class of officers under customs. The customs officers are divided into now 5 categories: adjudication and assessment officers, preventive officers, intelligence officers, audit officers, and appeals officers. So these are the various officers under customs. In that, the adjudication and assessment, if you see, principal chief commissioner or chief commissioner. Below that principal chief commissioner or chief commissioner, we have principal commissioner. First is chief commissioner, second is commissioner. And the next will be additional commissioner, below the joint commissioner, then deputy commissioner, assistant commissioner. So the hierarchy, if you see, first will be chief commissioner, below commissioner, and below additional commissioner, below joint commissioner, below deputy commissioner, below assistant commissioner. This is the hierarchy. This is for the purpose of assessment, adjudication and assessment. Whereas preventive officers, if you see, chief commissioner first same, commissioner same, additional, joint, deputy, assistant same, but these people will be called as preventive officers. The next, intelligence, here they will not be called as commissioner, but they will be called as Directorate General of Revenue Intelligence. So Directorate General of Revenue Intelligence, then additional Directorate General, first is Directorate General, then additional Directorate General, then additional director, not director general, additional director, then joint director, then deputy director, assistant director. So instead of chief commissioner, we need to call them as director general. Then below that, instead of additional commissioner, we call them as additional director. And instead of deputy, we call them as deputy director, assistant commissioner, assistant director. This is with respect to intelligence officers. Then audit, we don't have chief commissioner level. So it starts from commissioner only, commissioner, additional, joint, deputy, assistant. When it comes to appeals, so only one person we have, that is principal commissioner or commissioner. Then what about the next level? The next level will be High Court, Supreme Court, then CESTAT, so that will go. So with respect to officers under customs, only one principal commissioner or commissioner. The next amendment with respect to procedures is duty credit scripts. Let's try to understand what is this concept of duty credit scripts and electronic duty credit ledger. So we have got electronic duty credit regulations 2021, which says that any amount that will be refunded to the importer or exporter, rather than giving it to their bank account, it will be deposited into their electronic duty credit ledger. The balance that is there in the electronic duty credit ledger of those importers or exporters can be used for payment of basic customs duty, and if there is any balance in the duty credit ledger, that can be transferred to any other person. But how this transfer will happen is that the amount which is available in the duty credit ledger will be converted into a duty credit script, and these are called as e-scripts, electronic scripts, and this electronic scripts can be transferred to another person. So once the balance in the duty credit ledger is converted into a electronic script called as duty credit e-script, it will be having a validity. What is the validity of this e-scripts? Previously, the validity was 1 year, and now on account of notification 79/2022, the validity has been extended to 2 years. 2 years from when? 2 years from the date of its creation. So which means Once I created the duty credit script, when I transfer it to you, you can use it within a period of 2 years from the date I have created. That is the validity of this e-script. And we have non-applicability of electronic cash ledger provisions. So when this electronic cash ledger, now what we have seen so far is electronic duty credit ledger, now it is electronic cash ledger. These electronic cash ledger provisions will not be applicable in some cases. So previously, how we used to make the payment of customs duty? So once we file the bill of entry and the bill of entry is acknowledged, so we get the acknowledgement, then we will proceed to payment of customs duty. Upon payment of customs duty, the bill will be processed, and once the goods are imported, out of customs charge order will be passed. But now what they are telling is that you deposit that money into a ledger called as electronic cash ledger, just like GST in customs also, the concept of electronic cash ledger has been brought. Now, whatever balance that is there in the electronic cash ledger can be used for what purpose? Can be used for payment of duties. However, there are certain restrictions with respect to usage of, the balance in electronic cash ledger. What are those restrictions? So, the balance in electronic cash ledger, this concept of electronic cash ledger is exempted with respect to goods imported or exported in customs station where customs automated system is not in place. So when there are imports and exports happening in certain towns and ports where there is no customs automated system, then the electronic cash ledger regulations are not applicable. Or with respect to baggage, accompanied baggage also, no need to deposit into electronic cash ledger. Then suppose if you are making the payment of any amount other than customs duty, integrated tax, GST, interest penalty fees. What are the other amounts? The other amounts like demurrage charges, custodian charges, warehousing charges, etc. when you are paying, these charges are other than duty of customs, IGST, compensation cess, interest penalty fees, any other amount payable under any other law, not Customs Act. Under Customs Act, we need to pay only this. But the demurrage charges will be payable or custodian charges will be payable not under Customs Act. So those including MOT charges that need not be paid using electronic cash ledger, so that can be paid directly. Finally, the last amendment that we are going to discuss in customs procedures is with respect to customs import of goods at concessional rate of duty rules 2022. This ICDR, import of goods at concessional rate of duty, import of goods at concessional rate of duty rules. So these rules has undergone a tremendous change from 2021 onwards. So lot of notifications, circulars, lot of things they have given. And also that concept based question already asked in the recent exam for November 22, one question on capital goods also they have asked, and that question also we are going to discuss in this amendments video. First, we will try to understand the background of this import of goods at concessional rate of duty. First, when these rules are applicable and why these rules are applicable. There is a manufacturer or a service provider who is eligible for imports at concessional rate or imports without payment of customs duty under an exemption notification. So one manufacturer or service provider can import goods without payment of customs duty or at a concessional rate as per one notification. Second, that manufacturer or exporter to import that goods without payment of customs duty or at concessional rates, for what purpose? Either to manufacture any commodity or to provide any notified service excluding after sale service. So they are importing goods for what purpose? Either to manufacture the notified goods or to provide the notified service other than after sale service, or for supply to one end use recipient. So there is one end use recipient, say government or any other person, to supply to them we are importing under the exemption notification. Now suppose if the goods are imported for manufacture of notified goods, that manufacture can be done either by the actual importer or can it be done through job worker also. It can be done through job worker also. However, job work is not applicable with respect to jewelry, precious stones, gold, etc. But all other goods, the job work can be done. So this is the background of goods which are imported for the specified purposes can be imported without payment of duty or at concessional rate of duty to this manufacturer or to this service provider. These rules will be applicable. What is the procedure for import of goods at concessional rate of duty? Let's take an example that there is an importer who is located in Coimbatore, Tamil Nadu, and this importer is engaged in manufacture of some notified goods, and this importer is eligible for a exemption notification. Now what he need to do as a first step, he need to inform in the portal. Which portal? So ICE gate portal, customs common portal called as ICE gate portal. He need to file one form. What is that form? Form ICGR1, import of goods at concessional rate of duty rules 1, ICGR1. So in that ICGR1, he need to submit the information that he want to import these goods under this so notification. And the portal, after due verification, will be giving him an approval to import, and they will be giving one identification number called as import of goods at concessional rate of duty identification number IIN, which means he can import the goods at concessional rate or without any customs duty rate. And the third step is that, so he will be importing the goods in one port. Say he is importing the goods in Chennai port. So he need to go to the Chennai port and he will be filing a bill of entry. In that bill of entry, he need to give reference to the IIN what he has obtained. So the customs officer in the Chennai port is of the opinion that yes, he is eligible for import of goods at a concessional rate because so he got the IIN. So he will allow that importer to import the goods without payment of customs duty or at concessional rate of duty. So upon furnishing this bill of entry and IIN, and one bond also needs to be executed. That importer who is in Coimbatore, he need to execute a bond also in the common portal. So the moment the import happens, whatever benefit he enjoyed, to that extent the bond gets debited. For example, he is executing a bond. That bond will be usually a continuity bond, and this continuity bond will be, so for say some 5 lakhs and imported goods without payment of customs duty 2 lakhs. Now this bond gets debited for 2 lakhs. Now again when he makes import, he can make an import only to the extent of customs duty relief of 3 lakhs. Suppose if you want to make more imports, again he need to execute a bond. See, executing a bond does not mean you have to deposit that money. It is just the surety or security bond that you are executing with the customs department. That's how it will work. So now the goods, third step, the goods are imported by the importer into his place without payment of customs duty or at concessional rate of duty. And suppose if there is any non-receipt of goods or short receipt of goods. So because as per bill of entry, there could be 4,000 units. But actually when he imports it and after that he opens and see there are only 3,900 units. So there is a short receipt. So that information he need to communicate to the portal. Because portal is of the opinion that goods have been imported. Again when we are getting that remaining 100 units, portal will not allow or there will be further debit to the bond. Due to that reason, the short receipt or non-receipt needs to be intimated in ICGR2, form ICGR2 that should be intimated. The next step is that whatever goods that are being imported by this person in Coimbatore will be used for manufacture of notified goods. Now, on the imported goods, there could be some unutilized goods or defective goods. They imported some raw material, say, there will be some defectives in that or unutilized. That unutilized goods or defective goods should have been either exported back by that person because that enjoyed the benefit, of non-payment of custom duty or at concessional rate of duty. Either it should be exported back or it can be sold in India. Suppose if it is sold in India, whatever customs duty benefit they got, now they need to pay that benefit along with interest. If they export it back, no problem, no need to pay any duty, no need to pay any interest. But only one condition they need to fulfill, that the value of the exported goods should be greater than the value of the said goods imported at the time of import. Means there should not be reduction in the value, there should be increase in the value. Say they imported some goods are defective or unutilized, they are exporting it back. When they are exporting it back, the value of those exported goods should be greater than or equal to the value of goods at the time of import. So because whenever we have imported, we would have got one invoice. Now when we export it back, that will be given as a credit note by the supplier outside India. So the value should be matching, or the value should have been increased, but it should not be less. That is one condition. But according to me, that's a stupid condition, because it's very difficult to prove. Moreover, defective goods, so the officer will say, no, the value has come down, so therefore you have to pay duty like that. So this is one area subject to litigation. Then, or you don't want to export those defective goods or unutilized goods, no issue, you can sell it in India, but at the time of import, whatever concession you have got, that you need to pay now along with interest. Interest at what rate? Interest at the rate of 15% per annum from the date of import till the date of disposal. So we need to pay the interest at 15% per annum. So this is the procedure that needs to be followed. So total 5 points which we need to remember. So this chart will give you a clarity related to that. Then what are the forms that are involved? Already we know ICGR1. ICGR1 is prior intimation to be provided by the importer. ICGR2 is intimation regarding non-receipt of goods or short receipt of goods. And ICGR3 is a monthly statement. That is, in our example, that person who is in Coimbatore is importing the goods, right? So he will be utilizing those goods. So he need to update on a monthly basis what goods have been got, what goods he has been imported, and what he has utilized, consumed, and what is the balance left. That monthly statement needs to be updated in the portal, that is ICGR3. There is one more statement called as ICGR3A, that is the moment they file this, that they have made sales or they have used it for the purpose of notified goods, the bond amount debited, that will be recredited. For example, we imported goods, on this the customs duty benefit we enjoyed was 2 lakhs. Now this has been used for the particular purpose, and it is used in manufacture of notified goods or used in notified services or supplied to the end use recipient. Then whatever 2 lakhs that got debited in the bond will get recredited. If you want immediate recredit, don't wait till monthly statement. Now itself you can give that statement, that is in ICGR 3A. Let's see some FAQs in this regard. What is the information that is to be submitted? That is, as per step number 1, the importer has to submit that information, some information with the portal. So what is that information? Name and address of the importer or job worker. Then what are the goods produced or process undertaken? Nature and description of the imported goods or services for which they will be using that imported goods, and the notification, under which notification they are eligible for this exemption, and in which port they are intending to import, and in which premises they are going to carry out the process. Suppose if they are making a unit transfer, to which premises they are making the transfer, and to which person, end use recipient, for supply to whom they are importing. These details needs to be submitted in the information. Second, what is the procedure for sending the goods for job work? First, importer shall maintain the record of goods sent on job work and mention the same in the monthly statement in ICGR 3. And such goods should be under the cover of a delivery challan plus e-waybill. And such goods should be received after processing within 6 months. So usually in GST, we have a time limit of 1 year plus 1 year, but here it is only 6 months. So within 6 months, that goods which are sent on job work should have been received back. And job worker shall maintain the necessary records with respect to such goods. Now, here you may get a doubt. What will happen if the goods are not received within 6 months? Then there is breach of conditions. So breach of conditions means whatever benefit he claimed, he need to pay along with interest. Then, can the imported goods be transferred from one unit to another unit? Because not all process will be done by the same person, will be done by some other person also, or some other unit also. Some other person is job worker, some other unit means unit transfer. Then in that case, he can do so. So for that, for sending the goods from one unit to another unit, so that should be under the cover of again an invoice plus e-waybill. Why invoice plus e-way bill? Maybe unit to unit, these two units might have a separate registration. So then it will become transaction between distinct persons. So that's the reason why they are giving invoice plus e-way bill. What if these two units are within the state and they are not distinct persons? Then in that case, delivery challan plus e-way bill, because it is not a supply. So that's how it should be connected. Then what are the goods which are sent from one unit to another unit, and the process carried out, waste generated, etc. That should be mentioned in the monthly statement in ICGR 3. The next FAQ is, what is the procedure for supplying the imported goods to the end use recipient? So imported goods can be used in manufacture, or imported goods can be used in providing notified service, or imported goods can be used for making supply to end use recipient. Suppose in the third case, if imported goods are for supply to end use recipient, they should maintain the records of goods sent on job work and mention the same in ICGR 3 same way. They need to mention, and this will be sent under the cover of invoice plus e-way bill. In case of supply, for replenishment of export against supply, the end use recipient shall maintain records relating to receipt of goods, manufacturing process undertaken, waste generated if any. For example, this is like the end use recipient, depending upon their usage, we need to import and supply. Then the recipient also should maintain a record related to that. Then can capital goods be imported under these rules? Yes, capital goods can also be imported under these rules, but the time limit of 6 months, that is imported goods within 6 months, should be either utilized, unutilized, or defective should be exported back or sold in India. But that 6 months time limit is not applicable in case of capital goods. Then capital goods can be sold at any time, but if the capital goods are sold, then we need to pay the customs duty on that capital goods, because at the time of import of capital goods, we did not get any, we did not pay any customs duty, we got the benefit. So on capital goods which are sold, we need to pay the customs duty plus interest, but no need to pay the full customs duty. We need to pay the customs duty based on depreciation. At depreciated value, we need to pay customs duty at depreciated value. Now, what is the type of bond that needs to be executed? It is a continuity bond with surety or security as deemed appropriate by the officer. So they will specify for what amount we need to execute the bond, with the undertaking to pay that equal to the amount of difference between duty leviable but for the exemption and duty already paid. Means whatever benefit we enjoyed, for that we need to execute the bond along with applicable interest. Suppose if we fail to comply with these provisions, then next, what is the rate of interest and period for which interest is computed? Already we discussed that the rate of interest is 15% per annum, and it will be computed from the date of import till the date of payment of duty. Now, what is taken as the date of import? The date on which we got the out of customs charge order. So whenever we file bill of entry, we will get one out of customs charge order for home consumption. That date should be taken as the date of import. The next FAQ, what are the accounts and records to be maintained by the importers? So they need to maintain records related to quality, quantity and value of goods imported, the date on which goods are imported in the premises, quantity of goods consumed, goods sent for job work and received from job work, and re-exported if any, and what is the stock that is remaining. Then how to compute the depreciated value in case of capital goods? They have given a depreciation table. For every quarter or part thereof in the first year, we need to reduce 4%. For every quarter or part thereof in the second year and third year, we need to reduce 3%. For every quarter or part thereof in the fourth year and fifth year, we need to reduce 2.5%. Thereafter, for every quarter or part thereof, we need to reduce 2%. So 3, first 4, 3, 2.5, 2. First year 4, second and third 3, fourth and fifth 2.5. Thereafter, it will be 2 for every quarter or part thereof. And what should be taken as the period? The date it is put to use. The date it is put to use. The date it is put to use. Up to the date of its clearance sale. The date it is put to use till the date of its clearance, that should be taken as the period for which depreciation should be calculated. Should we follow calendar quarter? That is not given, because the words used here is straight line method as depreciated value allowed on straight line method, the quarter should be based on period specified and not based on calendar quarter. Now, on this depreciated value, we need to pay customs duty. How much customs duty? Whatever is the percentage of customs duty we have enjoyed as benefit, that percentage. For example, we imported the goods, capital goods for 10 lakhs. On that, the customs duty we have saved is 3.5 lakhs. Then what is the customs duty we saved percentage? 35%. That 35% we need to pay on the depreciated value. So, first we need to see what is the customs duty saved at the time of import divided by what is the value of capital goods at that time. We get a percentage. That percentage we need to multiply on the depreciated value, because if you see, customs duty on above shall be equal to difference between the duty leviable on such goods but for the exemption, and that has been already paid if any at the time of importation. Then next one, when the unutilized or defective goods should be exported or sold in India 6 months from the date of import, but this is not applicable in case of capital goods. Then what are the other compliances to be followed by importer? A monthly statement needs to be furnished in ICGR 3 within 10th of the month following every month, and if they want to get the recredit immediately, they can submit 3A as and when they want the recredit in the bond, and that 3A information will be captured in ICGR 3 whenever they are filing. Now you can have a look into one illustration. So illustration number 1, goods are imported on 10/12/2021, that is the bill of entry filed date, without payment of customs duty of 3,80,000, that is 10,000 units. 2,000 units of imported goods could not be used for notified services, and the same were sold on 28/3/2022 for 1 lakh. Applicable customs duty along with interest paid on 31/3/2022. Compute the amount payable. Now, what is the value of these goods sold? 1 lakh. What is the customs duty payable? So, 3,80,000 on 2,000 units. So, what was the value of the 2,000 units that were imported? So, 2,000 units were not used. So, 10,000 units imported. So, 3,80,000 is for 10,000 units. For the 2,000 units, how much is the customs duty? 76,000. Now, we need to pay that 76,000. And that 76,000 plus interest, what rate? 15%. From when? From the date of import, that is 10/12/2021. Why we are taking BOE file date? Because we don't have the out of customs charge order. So, that date we are taking from 10/12/2021 till the actual date of payment of customs duty, that is 28/3/2022, were sold on this, and the duty is paid on 31/3. So, 31/3. For this period, that is 111 days, we need to compute the interest payable, that is 76,000 into 15% into 111 by 365. Suppose in this illustration 1, if we had the out of customs charge order date, from that date we would have counted, so the interest. Then the next question, what will be the interest payable in above case if the value of the goods originally imported is 10 lakhs and they are capital goods? Then first see how much is the customs duty rate. So, customs duty payable 3,80,000 on 10 lakhs, that is 38%. Now, see what is its depreciated value. So, how many quarters we need to see. So, this is for how many quarters? When it is imported, from the date it is put to use, assuming that 10/12/2021 it is put to use. So, till when it is disposed of, when it is disposed of 28/3/2022. So, how many quarters? So, December, 10 December to 10 January, 10 February, 10th March, 1 quarter. Thereafter, 1 more quarter for part thereof. So, 2 quarters. We should not take calendar quarter, but we should take 3 months as 1 quarter. So, 2 quarters. So, 76,000, this 10 lakhs minus 10 lakhs into 2 quarters. 2 quarters into, for every quarter or part thereof in the first year it is 4%. So, 92 lakhs. 92 lakhs into 38%, 3,49,600 is the customs duty payable. And on this 3,96,400, 15% for how many days? Same. From the date of import till the date of payment of customs duty, 111 days. 15,948 we need to pay. These two illustrations I discussed in my regular batch as well as fast track batch as well as rocket revision batch for November 22 exam. And based on this, one question has come in November 22 exam for 5 marks. So, I am not telling that, definitely whatever I teach will come, but whatever I teach is complete. So, if you are learning this, definitely there are chances that these questions could come. So, rocket revision, so many students have said that that was useful. So, this time also we are planning for rocket revision, but this rocket revision we are just wanted to make it little early in the month of March itself, March first week itself, we wanted to start releasing the rocket revision. Previously, it was like 1 month before the exam during April or March end like that. So, this time we wanted to plan it in the month of March itself. Okay. So, please encourage and make use of it. Then, coming to illustration 3, Mr. X, a chemical manufacturer, imports a machine from Germany on 12 January 2019 for rupees 20 lakhs. Mr. X is eligible for concessional rate of customs duty on capital goods imported by him, subject to the condition that he follows customs import of goods at concessional rate of duty rules. Now, machinery was put to use on 1st February 2019. So, while calculating depreciation, we need to take from 1st February 2019. On 5th April 2022, X wants to clear the machinery for home consumption after having used the machine for the specified purpose. So, therefore, the date of sale is 5th April 2022. Now, what is the period here? So, 1st February 2019 to 1st February 2020 is 1 year. Again, 1st February 2020 to 21 is 2nd year. Then 1st February 21 to 1st February 2022 is 3rd year. And then thereafter February to April in the 4th year. So, we need to get the depreciation properly. So, from 1st February 2019 to 31st Jan 2020, 1 year. So, 1 year, 4 quarters. So, 4 into 4, 16%. Then 2nd year, so 1st February 2020 to 31st Jan 2021, again 2nd year, it will be for every quarter or part thereof, it will be 3%. So, 4 3s are 12. Then again 3rd year, 1st February 21 to 31st Jan 2022, full year, 4 quarters into 2.5, 3%. 2nd year, 3rd year also same. So, 12%. Then 4th and 5th year, it will be 2.5. But in this, February to 5th April, only 1 quarter into 2.5. So, 2.5%. So, total 42.5% should be depreciated. On what? On the value of the capital goods. What is the value of the capital goods that is imported? 20 lakhs. So, 20 lakhs depreciated by 42.5%. So, 11,50,000 will be taken as the depreciated value. And on this 11,50,000, what is the duty payable? So, if you see, the customs duty applicable is 20%, basic customs duty, concessional rate of customs duty 5%. So, how much we would have saved? 15%. So, that 15% is what we need to pay on this. This is the basic customs duty. And here they have not given anything about social welfare surcharge, but the question here is simple: calculate the basic customs duty payable by X. So, basic customs duty payable is the difference 15% on the depreciated value, and interest computation also not given. If interest computation is given, accordingly we will calculate the interest computation. Now, we are moving on to the last area, that is foreign trade policy. In this foreign trade policy, there are only 2 amendments. The first amendment is the existing foreign trade policy 2015-20 got expired by 31st March 2020, and it has been constantly extended. Now, it is extended till 31st March 2023. So, the same FTP what we had from 15-20, they were keep on extending because of the COVID, and now they have extended it further up to 31st March 2023, which means for May 23 exams, definitely it will be the old foreign trade policy. Maybe for November 23, there could be a change. So, that is the first amendment. The second amendment in FTP is related to RODTEP scheme. So there was an amendment last year itself related to removal of MEIS. So this merchandise export from India scheme has been removed, and instead they added one scheme called as rebate of duties and taxes on exported goods, RODTEP scheme. What is this RODTEP scheme? You have exported some goods, and these exported goods has got some burden of local taxes. So majorly customs duty or GST, we will get the benefit in the form of refund. But there are some local taxes like local body tax, municipal taxes, mandi tax, like that. There are some local taxes. These taxes will not be given as a refund. So in order to give the benefit to the exporter, refund of the taxes, local taxes that were borne on exported goods, this RODTEP scheme has been brought. Depending upon the product that is exported, a percentage of FOB will be given as an incentive to that exporter. So this incentive, what he can do is that he can use it, that is like a duty credit script. He can use it for payment of custom duty, or he can transfer. Now related to that, so we have got certain amendments. So in that, regulation number 4, before amendment, recovery of duty credit. Suppose if the credit has been wrongly availed by the exporter. So wrongly the credit has been availed, duty credit has been availed from the exporter. Before amendment, it can be recovered either from the transferor or from the transferee. Even from the transfer it can be recovered. But now they made amendment stating that if the transferor has got the duty credit wrongly, then that can be recovered only from the transferor. Even if the transferor has transferred the duty credit to the transferee is now relieved. So from transferee it will not be recovered. That is amendment in regulation 4. Then similar amendment in regulation 5 also. If the export proceeds are not realized within the time stipulated under FEMA, that is 9 months, so then he has to pay back whatever duty credit he has got within 15 days. Otherwise, it will be recovered from both transferor if transferred from the transferee. But now after amendment, it has been given that if the transferor fails to realize the export proceeds within the time stipulated under FEMA and not paid the duty credit within 15 days, it will be recovered along with interest only from the transferor but not from the transferee. That's the second amendment. Then one more amendment in regulation 6, that is, earlier credit on subsequent exports were disallowed to the exporter and the transferee if they have paid only the duty credit wrongly availed. However, now that restriction is applicable only to the exporter. That is, during the pendency of this recovery, no further credit shall be allowed to the exporter. Previously, no further credit will be allowed to the both exporter as well as to the transferee, but now they have omitted the transferee. In short, so RODTEP benefit whatever is given to the transferor, because of non-compliance of provisions, will be recovered only from the transferor but not from the transferee. So this is the amendment. With this, we completed all the amendments in customs, FTP, including GST. So now many students were asking me whether we need to buy the new books. Not required. If you have November 22 books, use the same November 22 books plus watch this amendments video plus you have a PDF, you can download that PDF and keep it. If you feel, no sir, that will be difficult, we don't have that habit, then you can go for new books, it's up to you. But I am not telling that you should go for new books only. If you have November 22 books, however, if you are having May 22 books or November 21, May 21 and all, please purchase the new set of books. There are 3 books which I will be releasing for every attempt, that is Revise. That Revise is a concise guide, contains all the provisions with illustrations, charts, but there won't be any bare act in that, there won't be detailed analysis in that. To the point, from exam point of view, I made that book, single volume only, it's a color book. that you can buy if you want to read everything thoroughly, in the sense like you already would have prepared, now you want to study or you want to study detail, you can go for that. And second book is That's It book, which is purely for last minute revision. I will be doing rocket revision from that That's It book only, to the point. So crisp information, one line summaries in all the concepts, mainly for that 1 day or 1.5 day before exam. Then finally, solved workbook. Solved workbook is a compilation containing lot of all past exam questions, MTP, RTP questions, and the self-coined questions by me, even CMA, CS, every questions will be there in that solved workbook. Around some 900 questions will be there. So it's a big compilation. In that, I will also give what are the top 200 questions and top 50 questions. So that will also be provided. Now, I will recommend, suppose if you don't want to read much theory and if you want to learn to the provisions, already you know, but you want to learn crisply and practice more, then you go for That's It plus solved workbook combo. If you want to read little bit and then apply that into the problems and solutions, go for revised book and solved workbook. And if you want even guidance even 1 day before the exam, buy all these 3 books. Thank you. Thanks a lot. Thanks for supporting. Please share this amendments video with your friends as much as you can and keep supporting me. Signing off. Take care. Bye bye. We'll meet you again on Rocket Revision series.